Hello and welcome to How to Read Charts Like a Pro, Level 2. I am Dr. Tom Carr, aka Dr. Stocks. I am the founder and CEO of Befriend the Trend Trading, which is the parent company of the Dr. Stocks brand. We have three primary websites. Our flagship website, founded in 2002, is drstocks.com. drstockstrading.com is our newest website and features the Hot Stocks letter and the Penny Stocks letter, along with other trading resources. And ichthusletter.com, that's IXTHYS letter.com, is our site that's aimed at long-term buy and hold investors, as well as those seeking guidance in the area of personal finance. But enough about me. Let's get on to see what you're going to be learning today in this webinar.
I want to first start by showing you what we'll be talking about today. We're going to start quickly with just a brief intro to charting as a price prediction tool, and especially as we're looking ahead on different time frames, just how predictive is the technical analysis of charts going forward. Secondly, we'll look at the 7 most profitable chart patterns. 4 of those are bullish patterns, 3 of those are bearish patterns. And thirdly, we'll look very briefly at one nifty trick that we can take away from Elliott wave theory. I'm not an Elliott wave theorist. I'm not even really a big fan of that theory, but there is a particular emphasis of Elliott wave theory, actually a couple of emphases that I want to point out that I find to be very helpful, particularly in keeping us out of bad positions. And then fourthly, we'll look at 3 key technical indicators. We described 2 of those 2 indicators in Chart Reading 101. We're going to be adding 3 new indicators to our chart as we work with charts today. Fifthly, we'll be looking at a series of candlestick formations that we can use to pinpoint trend reversals. I'll let you know there that I don't think candlesticks are that helpful in discerning continuation of trend, but they are very helpful in discerning the end of the trend, so we'll use them that way. Sixthly, we will be looking at how to use the chart to determine where to put our stop losses and where to set our exit target prices. Seventhly, we'll be using intraday charts to pinpoint our entries. This is a kind of a new technique I've developed myself in light of the high-frequency trading that's going on in the current market. It's been going on for several years now, and it's really making a mess of things, but we can actually use it to our advantage to scalp a few extra cents on our entry price and make our trade that less risky and that much more profitable. And then lastly, we're going to put all of it together, both Chart Reading 101, 201, into a 5-step chart reading trading method that you can use right at the next day's open to find, trade, manage, and profit from some great trades. So that's where we're going.
Before we look at the material itself, let's get the disclaimer out of the way. Everything taught in the How to Read Charts Like a Pro Level 2 webinar, including all strategies, systems, methods, and techniques, is for educational purposes only. No promise or guarantee of any kind is being made. Those watching this webinar assume all risks associated with any activities related to the educational material herein. They understand that active trading can result in the loss of trading capital, that only risk capital should be used for active trading, and that active trading may not be suitable for everyone. All material is copyright and may not be copied, redistributed, or resold without permission. Okay, with that out of the way, let's get on to our webinar itself.
So, charting as a tool for price prediction. What I want to emphasize here just briefly in this first section of the webinar is that the technical analysis of charts that we'll be talking about and instructing in today is a tool of prediction. We are predicting where we believe the price of a stock will be going forward into the future. We know where price has gone because we can look at the price chart itself, and that tells us the path that the price has taken up to the very moment of our eyeballing the chart. What we don't know is where price will go into the future, but we're using all the techniques that we'll talk about today to make the best possible prediction of stock price going forward. Now, the real question is just how far forward are we talking about? Now, when you're talking about the fundamental analysis of stock companies, you can make predictive measures of price going forward quite some time out into the future. So a typical fundamental analyst, someone who might be hired by, say, Goldman Sachs or Morgan Stanley, one of the big investment banks, to research individual companies, will make a prediction of where that stock price is expected to go over the next year. And most analysts will give an annual estimate or guesstimate as to where they think price will end up by the end of the year, within 12 months. And of course, they adjust that as new information comes online from earnings and company headlines and that sort of thing. But for the most part, they're working with a 12-month time frame, and in some cases even longer. You can make 3 to 5 year predictions based on what they think the market is doing, what the economy is doing, what the particular sector or industry of the company is doing. And that's fundamental analysis. Fundamental analysis has a much larger time frame in mind when it makes its predictions. Not so technical analysis. Technical analysis is a short-term predicting tool, and I think it's very important to keep that in mind. You'll have a whole different mindset when you start managing your trades if you can keep in mind that technical analysis by itself is a short-term prediction tool, not a long-term prediction tool. And I'm going to give you some general guidelines here in just a moment. For my money, what I do in my own trading and how I manage our hedge fund, the 818 fund, is I combined technical analysis with fundamental analysis. I use fundamental analysis to make sure I'm buying fundamentally sound companies with strong growth and valuation, etc., and I'm selling short fundamentally unsound companies. And then I use technical analysis to time my entry, to gauge the stock price going forward, to where to put stops and target prices and so on and so on. So I use technical analysis quite heavily, but it is one tool among several that I use. If you're relying on technical analysis by itself, then here's what you can expect as far as the predicting power of your analysis goes. If you're working with a daily chart, and all of our discussion today, for the most part, with one exception, will be looking at the daily chart, you're looking at a prediction estimate going forward about 3 to 4 weeks. So in other words, when I look at a price chart of, let's say, Apple Computer, I'm looking at today's date and all the previous trading data going back several months on the price chart. My best guess of where Apple stock will be priced using technical analysis alone is only about 3 to 4 weeks out. So when I say I believe Apple Computer is going to go up 10%, what I'm saying based on technical analysis alone is that that's going to happen in the next month. And that's about all we can expect from technical analysis. Now, that's a lot, and in fact, the predictive power of technical analysis is amazing. It is an amazing, powerful tool, but it's a short-term tool, so really keep that in mind. If you're buying a chart because you believe the stock price is going to skyrocket to the moon, say 100%, 200% over the next year, you're not making that prediction based on technical analysis, because there's nothing in the chart that can give you that kind of long-range certainty. Now, if you want to make longer range predictions of the stock price going forward, what you can do is move up to the weekly chart. Weekly charts are amazingly powerful tools. I refer to them quite often. When you're using a weekly chart, you're extending your predictive power out to 4 to 5 months, close to half a year, 1 quarter to half a year, 1 to 2 quarters of time. And that's a pretty good range. So if you are not such an active trader and you like to hold on to your stock trades for several months at a time, then I would suggest your key time frame is going to be the weekly chart. And then to time your entries, you would scroll down to the daily chart. What I'm going to be teaching you here is how to use the daily chart and then scroll down to an intraday chart. In most cases, this will be the 10-minute chart in order to time your entries a little more carefully. We'll see how that's done a little later in the webinar. Now, some people like to use intraday charts. The hourly chart is a favorite among short-term swing traders, what are sometimes called scalp swing traders, or swing, I forget the name of it, swing scalping, swinging, something like that. In any case, you're probably using the hourly chart, and in that case, your time frame going forward is only about 3 to 4 days. And then if you're a real day trader, you're likely keying off of the 5-minute chart, especially if it's a liquid stock. And if you're day trading the E-minis or some of the Forex currency pairs, you might even be scrolling down to the 3-minute chart, the 2-minute chart, even the 1-minute chart. In the case of the 5-minute chart, you're looking ahead about the next hour to an hour and a half. And that's really about it. So if you're buying a day trade at, let's say, 10:30 in the morning based off the 5-minute chart, and you're expecting to hold on to it the whole day, you're probably not doing yourself good service that way. What you should be thinking of is the duration of your trade from the 5-minute chart lasting only about an hour to an hour and a half. So in other words, if your trade hasn't been stopped out or hasn't hit its target within an hour to an hour and a half, you take another look at the chart. If you still like it, you can hold on to it, that's fine. You might have to adjust, in fact you will probably have to adjust your stop and your target. But if you don't like it, just get out, because the original prediction that you made has changed for whatever reason, and you'll need to close that trade. So on to point number 2, the 7 most profitable chart patterns. And to determine these most profitable chart patterns and most reliable chart patterns, I'm relying on a valuable resource. It's the encyclopedic book called The Encyclopedia of Chart Patterns by Thomas Bulkowski. Bulkowski is to chart patterns what, I don't know, Yo-Yo Ma is to the cello, something like that. He is the guy on chart patterns. He's published the most, he's been around the longest, and his material has stood the test of time. And the thing that Bulkowski has done that is so helpful for us here is that he did a several-year, multi-year study of every stock in the S&P 500, and he wrote down or noted every chart pattern that they made. Not only the most familiar chart patterns, you know, double bottoms and head and shoulders and things like that, but also a number of less familiar, less common chart patterns. He noted how often they moved in the predicted direction, how far they went in the predicted direction, and how often they experienced a reversal of direction or a loss. And then he gave each chart pattern a value based on that data, and he listed 1, 2, 3, 4, 5 the chart patterns in order of most profitable and most reliable. And so I'm taking the cream of the crop here. I'm taking the chart patterns that are at the top of his list, with a couple of exceptions that I'll explain in just a moment. So the 4 most bullish patterns are these. Number 1 bullish pattern, in fact it's the most bullish, most profitable, most reliable pattern of them all, bullish and bearish combined, is the rectangle top breakout. Now, don't worry if you don't know what that means. We'll be looking at some examples in a little bit. This is a pattern that on average averages 52% after breakout going forward, and I don't know how long of a period that is. It could be a year period. I just don't know. But according to Bulkowski, it averages 52% per occurrence. That's a massive return. The falling wedge, which is a reversal pattern, so in other words, a falling wedge usually occurs in a down trend, and it indicates that once that wedge is broken to the upside, that there will be a reversal of trend, and that averages 43%. Thirdly, the ascending triangle breakout, which is a continuation pattern, so it usually occurs in an uptrend. Price consolidates into an ascending triangle formation. Once it breaks out to the upside, on average, you should see a 44% return. And fourthly, the double bottom, good old standard double bottom. And this is a reversal pattern, so you find these at the bottom of downtrends, and it indicates that the trend is ready now to reverse to the upside. On average, it does so to the tune of about 40% per trade. So those are the four bullish chart patterns, and I took these right off the top of Bulkowski's list of the most profitable chart patterns. The bearish chart patterns are, I had to fiddle with these a little bit because there were some patterns on there that are just so uncommon and so difficult really to spot that I decided they weren't really worth talking about here in this webinar. But on the downside, a symmetrical triangle is the most profitable and most reliable bearish pattern, and a breakout to the downside of the triangle averages about 24% per trade. The descending triangle with breakout averages about 19% per trade. And then the good old standard head and shoulders top, which is a reversal pattern, so you normally see these at the top of uptrends with the expectation that the trend has come to an end, it's ready to reverse to the downside, and it usually does so. Now, it averages more than the number 2 pattern, 27% versus 19%, but it has a higher failure rate, so that moves it further down the list in Bulkowski's estimate. So we're now going to move to look at specific patterns themselves, patterns that fit these 7 examples so you can recognize them easily from the chart. And I want to start by going to a website that will help you find these patterns among the thousands of stocks that are trading. It actually has a screening tool that will enable you to pull out from the market charts that in most cases fit these patterns. So I want you to point your browsers to finviz.com, finviz.com. It's a free service, free website, and I'll meet you there after this. All right, so here we are at finviz.com. It's a free site. It is, in my opinion, the best one-stop shop for not only technical analysis, which is what we'll be focusing on here today, but also fundamental analysis. And when we're talking about chart patterns, finviz.com, without any charge to you and me, does a lot of the screening and finding work for us. Down here you have several lists of stocks that are displaying chart patterns. You can also build screens that search for specific patterns, and that's something we'll be talking about when we get to the last part of this webinar and the 5-step process. I'll show you how to do that. But what we can do for now, and we want to look at some examples of the different chart patterns, is to use the lists that FinViz already has here in its database. Now, the first most bullish chart pattern, the one at the very top, the granddaddy of them all, is the rectangle pattern. It is a bullish pattern. It normally appears at the top of an uptrend, and that's where we would expect to find it. So if we find if we find a rectangle pattern at the bottom of a downtrend, that's not necessarily bearish, but it's not one that we're looking at here. The statistics that Bulkowski gives us, the most reliable, most profitable chart pattern, is the one that appears at the top of an uptrend. I'll show you what that looks like in just a minute. So all 7 patterns, the great best patterns, most reliable, most profitable patterns, are all here for us. So let's click on the channel, the sideways channel, or what Bulkowski calls the rectangle pattern. And as you'll scroll down the list, you can see that most, if not all, of these stocks are showing some form of a rectangle pattern. So again, we want to find a rectangle at the top of an uptrend. You can see several here that are at the top. You can also see maybe a few that are like this 4X right here at the bottom of a downtrend. We don't want that. We also don't want to trade thinly traded stocks, like this is just a messy looking chart here. We're going to avoid that. We also want to rule out a gap, a big gap up like that, because that price going forward right there is just dead money. It's not going to go anywhere. That was probably a buyout or something unusual. What we want are sizable moves from top to bottom within the rectangle at the end of an uptrend. AXP, which is American Express, you're familiar with that company undoubtedly, is a classic looking bullish rectangle, and it already has the breakout for us. Broke out day before yesterday on very strong, better than expected earnings. And you can see down here these little green bars represent the volume on those days. They're quite a bit above average. So that is a classic bullish breakout. That's one you would want to jump all over if you were fortunate enough to grab it right at the open 2 days ago. I wouldn't jump on it so much right here. You might wait for a little bit of a pullback. One of the cool things about the rectangle pattern is that the top line here, the top horizontal line, of course, is your resistance line. It's the top of the rectangle. And once, as long as price is below that line is going to act as resistance. Once price goes above it, it will now tend to act as support. So you can buy a little pullback down to or near that horizontal line, and that's an excellent entry. You've got the breakout, you've got a little pullback to support. Used to be resistance, now it's support, and that is a very low risk, high profitability entry. So I love that about this rectangle pattern. One other thing to say about the pattern, we'll be talking later about where do you put your stops and your target prices, but while we're looking at patterns, I want to show you how you do that with respect to chart patterns. In the rectangle pattern, we know that this horizontal line at the top is going to act as, or we expect it to act as, support. In this case, you also have a little bit of a gap. That's about a dollar gap right there. And gaps like that in bullish direction also tend to act as support. So I would put, if I were trading this, I would put my stop loss certainly below the now support line, the top of the rectangle, but I'd also put it just below that gap. So in case the gap fills in, I have still a cushion against any further drawdown, because often gaps do fill in and then they reverse back in the direction of the main trend. So in case the gap gets filled, I'm going to put my stop just below that, probably around 75.45. Now you also see on this chart there are a couple of moving averages here. You do have your 20-day moving average and the 50-day moving average. We'll look at those a little more closely in just a moment. You can, if you want to take a little more risk on, put your stop loss below that 50-day moving average. That's the one that's almost horizontal. So there are a couple of places you can put your stop loss. The lowest risk stop loss would be one just below the former resistance line, now this support line right in there around 72 something. Sorry, 77 something. Now, where is your target on this? Your target is very easy to calculate. You simply take the horizontal support line, subtract that from the horizontal resistance line, and you get the measured move within the rectangle. You add that to the former resistance line, and you get your target price. Let's take a closer look at this AXP chart, and you'll see what I'm talking about here. So let's go ahead and draw in our lines. So we're going to put our horizontal resistance line there, our horizontal support line there, and just a couple of points that I didn't mention previously. You have a rectangle, and you only have a rectangle once you have 4 touch points, 2 at the top and 2 at the bottom. I mean, that should make common sense, but you do need 4 touch points. Without 4 touch points, if you only have 3 touch points, you're going to end up with a triangle of some kind. And what we're talking about here is a rectangle. So for a rectangle, you need at least 4 touch points. In this case, we have 1, 2, 3, 4, 5, and almost 6. Now, the fact that AXP did not come all the way down to 71, which is where the support line is, but instead reversed to the upside, is a bullish sign. Now, that means that big money was starting to get on board AXP prior to earnings, because they knew, they didn't know for sure, unless they had insider trading, illegal information. but they had very good sense that AXP was going to beat earnings, so they got on board early before the breakout, before earnings were announced. When a move within a rectangle does not come all the way down to support, but instead reverses back to the upside, that's a bullish sign, and you can anticipate the breakout by getting on board somewhere around here, 73, maybe 74, 74.50, toward the close of that reversal day. There are other techniques you can use to get on board early before a breakout, but that's one of the best ones, one of the easiest ones to trade. The other thing to mention is that the measured move here is from a low of 71 at the support line to a high of 78 at the resistance line. 78 minus 71 is 7. You add 7 to 78 and you get 85. So 85 is our target on this trade. Now, if I had gotten in right at the opening 2 days ago when it announced earnings around 78, I'd be very happy with a target of 85. I could put my stop down here probably somewhere below 76. 75, 85 would be a nice place to put my stop. I'm in for just a little over $2 worth of risk, and I'm looking at a potential of $7 worth of profit. And that's a very healthy risk to reward ratio. Now, it's already up here at 80.50. I probably wouldn't buy it just here. I'm waiting for a little bit of a pullback before I buy that. But that's a great looking chart. That's exactly what you want to see with a rectangle pattern. Now let's move on to a second chart pattern. And it is the falling wedge, or wedge down as FinViz calls it. And you can see here a number of nice looking falling wedges. Some of these are ETFs, exchange traded funds, on the bearish side of the market. So these are inverse funds. Because the market is ramping up to new highs, these are ramping down to new lows. But the fact that they're doing so in a wedge pattern is a little bit, a glimmer of hope for the bears, and maybe just a wee bit of a cautionary note for the bulls, because wedges do tend to reverse. They do tend to form at the end of trends rather than in the middle of trends. So with that said, let's look at some stocks rather than ETFs that are forming falling wedges. And a falling wedge you expect to find in a downtrend. And so this one of Doug, which is an ETF, it's an inverse ETF, is a classic one. It's a very nice looking wedge in a clear downtrend with the wedge formed. Now the wedge is always formed with lower lows and lower highs, but the highs are falling faster than the lows, and that's what forms the wedge. You can see this pattern here is getting narrower and narrower as you move from left to right on the chart. Okay, so let's look at the chart of RIG, which is a Transocean Limited. It's an oil and gas drilling exploration company, as you can read right there. It's not exactly in, well, it is in a downtrend, but the wedge is not exactly at the end of a downtrend. But if we look back at the weekly chart, you can see that it did hit a high up here near 58 or so, and it sharply downtrended. We get a little bit of a relief rally, a 3-week relief rally, and then we get the wedge. So we could say that the wedge is coming in a downtrend. It's just that you have to go back a little further to see the downtrend. So let's look at RIG on this chart here so we get a better picture of it. And there we have our downtrend, our falling wedge. Let's zoom out a little bit. We get a fuller picture of what's going on here. And let's annotate the chart somewhat here. So you're going to be putting in a downtrend, as I mentioned in the first webinar, you always draw in your upper trend line first. And that one right there is not going to work because we can't touch the top of those highs. So we will pull this in a bit and put the top line, the resistance line, right there. And then the support line can be drawn in something like that. We want to try to incorporate as many of these price points as possible And I'm not worried about the intraday data falling out of the wedge. I'm simply looking at the wedge itself. This is a nicely formed wedge. It's nice because you have a wide, very wide opening at the beginning, and it's becoming narrower and narrower, and boy, that's a sure sign of a breakout. So, and you can see the price right here off to the right edge of the chart is beginning to break out. I'm not sure if it exactly closed over our line or not. It's very close to it. It looks like next week will be a bullish week for this stock, at least according to this particular chart. So, as far as understanding the measured move of this and where you would place your stop loss, in this particular case, this downtrending line is likely to act as support in any reversal after the breakout. And again, we're looking for an upside breakout from here. We're looking at price to jump up to 47 or so very quickly. This resistance line here will act as support once price is trading on the outside of the wedge. But because the resistance line is falling so sharply, you don't want to keep moving your stop down to keep it below the resistance line. So that's not really a very good place to put your stop loss. So it's a little trickier with a falling wedge. You do have the 50-period moving average parallel here to that trend line, and sometimes that's a good place to put your stop loss. Keep it under the 50-period moving average, maybe a nickel or a dime. But in this case, because it's falling so sharply, that also is not a very good place. So what I like to do then is, let's blow up the chart a little bit here. Let's move back out and look at that far right edge a little more carefully. And we could see that there's this nice little 2-week uptrend right here that started below 44.50 and is closing up near 46. And if we draw a trend line underneath that, that should also act as some support, and so I would be putting my stop loss below that little trend line, so probably somewhere around 44.80, 44.85. I would be looking to buy this stock somewhere around 46, just so we make sure we do have a nice clean breakout, preferably on the close. So nice looking wedge here. You're going to put your stop loss at about 44.85. Where do you expect this to target? Very easy to find that. You take the wedge itself, and from the beginning to the end, prior to the breakout or at the breakout point, from the beginning of the wedge to the end of the wedge, find the middle point. You don't have to do it exactly. I just eyeball it right about in here. It seems to be about the middle. And then start at the bottom, the middle, which is around 45.50. Go to the top, which is about 50.50. And that's a 5-point move. So you would add that to the breakout point of 46, and you get a measured move of about 51 points. 51 points is way up here. That seems pretty reasonable on a wedge of this type. The problem with that is you have the 200-period moving average in between at around 49.50, and I would guess the price is going to get stuck there, just as it did back here, and may not get too much further than that before distributing some shares, consolidating, going into a 2 to 3 week hibernation, if not a pullback altogether. So I would prefer to get out below that. So I'm going to enter at 46, get out at 49.50, put my initial stop loss at 44.85, and move it up from there. Let's look at now the ascending triangle pattern, which is the third of our bullish patterns on the list. Triangle ascending. Here's a nice looking list of ascending triangles. And just like the rectangle pattern, we are looking for this pattern at the top of an uptrend. TDIV is looking pretty good here. What else looks good as far as... Now see, here's an ascending triangle at the bottom of a downtrend. We don't want that. BIZD is an ascending triangle for sure, but that's just all kinds of... That's sideways trading action. You don't really want to see that kind of stuff. That's a bullish looking chart, but not for this particular pattern. That's another pattern altogether. TRI looks pretty good. We are in an uptrend. We can see the 200-period moving average rising nicely and steady. We are seeing the 50-period moving average rising and then falling flat, but slightly rising still. That's a good sign. You expect to see in this kind of sideways consolidation action the 50-period moving average to go flat. It certainly does in a triangle. I'm sorry, in a rectangle it goes flat. It will go flat in a triangle if the triangle is quite large. This is a fairly large one. And you also expect to see the 20-period moving average going up and down over the 50-period moving average. So all of that is par for the course. This is a 1, 2, 3, 4, 5, 6 touch ascending triangle. This is a nicely formed ascending triangle, very bullish looking chart. Let's look at this a little more closely and see how we would play this one. So let's zoom back out a bit to give this one more room. Here we go. Let's put in our patterns. We can see that we are in a nice looking uptrend. That's a nice looking channel uptrend right there that then broke. It broke to the downside, not necessarily bearish, just means that we're going to see some price consolidation, which is what we're seeing. Now, this triangle we're going to have to fiddle with a little bit. One of the differences between finviz.com and stockcharts.com is that they have a different way of indexing the charts. So they're, one is on a percentage basis, one is on a price basis. So you're going to get some discrepancy between the two on some of these lines that we're drawing in. But nevertheless, this is still a very nice looking ascending triangle. We're still within the pattern, so you can anticipate the upside breakout here by buying low. Ideally, you would like to see it touch the lower trend line again, or somewhere down here around the 50-period moving average would be nice. And I'll show you some ways you can use intraday charts to gauge your entries, to time your entries a little more carefully, a little more precisely. But frankly, I'd have to do some volume work on this to determine this to be the case. But this looks like traders are accumulating here to anticipate the breakout. So I kind of like this right around 35 right here. So if I bought this at 35, where am I going to put my stop loss? You could put it simply below the 50-period moving average, which is a few cents below the last intraday lows of the past 3 days of trading, 4 or 5 days of trading. That's a pretty good place to put it. But in the event that it does come down and kiss this lower support line again, I would prefer to put it below that. So probably around 34.25, something like that is where I'd put my stop. So I'm in at 35. I'm risking about 75 cents on the trade. This is not a very volatile stock. It's probably not one we would be trading anyway, but it makes for a nice looking chart. Where do you put your target? Just like the falling wedge, and like the falling wedge, we measure it in the same way. We start off here at the left side of it, the beginning of the triangle, which is normally your first touch point. It's not quite a touch point, but it's pretty close. So this is your first touch point. This is your right side edge, the hard right edge. The middle point between the two is right about here. At the low, we're at 32.50. At the high, we're at 35.50. That's a 3-point spread. You add that to 35.50, you get a target of 38.50. Simply done. And that's the ascending triangle. Let's look at one last one of the bullish charts. And to do that, we need to go to the double bottom list, which is right here. Double bottoms are a little harder to screen for using the FinViz software. What you really want to see, the ideal double bottom formation looks like a very clearly formed W with the 2 points down below and a nice clean V pivot point in between the two bottoms. You also want to see the two bottoms not that far from each other, maybe a couple of months at the most. I don't have a hard and fast rule on that, but I like to see a double bottom formation that is formed within a 2-month period. Make some exceptions to that, or less. What you're going to see on this list of charts here are a number of double bottom charts that don't fit that description. I would rather pass on them. Let me point out some of the things that I don't like. Like, for example, PRFS is clearly showing a double bottom. Both pivot bottoms are at the same price level, around $25 per share. That's what you want to see in a double bottom. But you've got, look, 1, 2, over 3 months of separation between them. And what you want to see is those two bottoms close together, because then you've got that psychological advantage. Those buying here at the second bottom on the right-hand side are looking back only a month ago or so to the other area where price pivoted off the low and saying, hey, this is strong support. Let's buy it again. And if the previous bottom is 3 or 4 or 5 months out, then you lose some of that psychological advantage. So you want to see the two bottoms close. You also want to see the pivot point in the middle very clearly defined. Let me see if I can find an example of one that's not very well defined. Here is, well, okay, a couple of ones. Here's a GDX, which is the gold mining index. It's an ETF, exchange traded fund. You have more or less of a double bottom. It's not that quite the same price level, but it's close. One here in late June and one here mid-October. But in between, you don't have that nice clean W formation. You've got, you know, there's a high here and then a low and then a kind of little double top and then a low and then a little pivot high and a back down again. So it's all just messy in there. I don't want to see mess. I want to see a nice clean W pattern, nice clean pivot point between the two bottoms. Here's another one, this lag chart here. You do have a double bottom early July, early September, but then just a lot of mess in between. So I don't want to see mess. I want to see a nice clean W formation. I scrolled through these charts earlier, and I did find one that does fit that bill quite nicely. In fact, it's one I may end up trading on after I do the seminar. And it's this stock right here, ACC, which is American Campus Communities. It is a REIT, which is a real estate investment trust. They usually carry a dividend. This one carries about a 4% dividend. Now this, you can see, very clearly defined W. First bottom here in September, a nice clean pivot point between the two bottoms. Second bottom here right at the same price point in early October, and then a nice strong volume push off of the double bottom. Let's look at this more closely. So here we have the chart of ACC, and you can see on the stock charts chart we also have again that nice clean W formation showing there. It's very evident. I also like the fact that in the right hand upside you've got all these strong volume bars every day. The close is higher than the open. That's what you really like to see. In the previous uptrend off the first bottom, we did have a few good initial pushes, but then you started to see a little bit of distribution fall in here, which is what you have to see as it makes this pivot high between the two bottoms. If there were not that distribution, you wouldn't have the pivot high, you wouldn't get the double bottom. So what we're seeing, though, is that this second push higher is much stronger from a volume basis than the initial push higher, which is to be expected if the double bottom is going to break out. Now, how do you play this? First of all, let's draw in our trend lines. And we're going to put the horizontal line over the top of that pivot high. That is our resistance line, and our support line goes underneath the lows. Now the measured move between the two is the bottom here is about 32.75 and the top is about 37. So that's a good 4.25 point move. We add that to 37, we get 41.25, which is just a little bit above the 200-day moving average. So that 200-day moving average would be our target. And if we scroll over a little bit to the left here, we can see that that also coincides with an unfilled gap right in that area right there. So that is something that's going to act as a magnet on price. Any unfilled gap tends to get filled sooner or later. It doesn't get filled right away all the time, but sooner or later they get filled in. So we've got some nice confirmation here that our target price, which would be somewhere around in there, is a nice place to shoot for. I'm anticipating a breakout, but to play this cleanly, you would wait until price closed above 37, above the pivot high. So any close above 37, you would buy it on the close, or you could buy it at the next market open. And where would you put your stop? Well, you would put your stop below the pivot high. So we're anticipating that the pivot high, which was resistance, is now going to act as support. And I would give it a little bit of room, so I'd probably put it down about 36.25, something like that. Maybe even a little bit lower, 35.85, to give it a little bit more room. And my expectation is that over the next, month and a half, we'll see a nice move up to the 41 area. Can you get in on this before the formation breaks out to the upside? Yes, you can, certainly. And the one indicator that I like about this, the one signal that would have gotten me in early, is this big volume bar, which you can see right here on that big upside day. That's a big high volume push off the low. That high volume tells me that professional money is getting on board and getting behind this stock. That's well over 1 million shares traded that day, much above average. And if you were to get in early, you'd be getting in at around 34.50, and that would have been a very nice entry. And you would put your stop loss in this case below the support line, down around 32.25. That gives you a lot more room to the upside and gives you more profit potential to play with. Okay, so we're moving now to the three bearish chart patterns, and the first one up is the most reliable, most profitable one, is the bearish symmetrical triangle breakout. Now, in FinViz, you want to click on, if you're looking for a list of those formations, you want to click on the chart pattern called wedge. That's the same thing as a symmetrical triangle. And we're going to have to eyeball these pretty carefully because, first of all, you're going to see triangles of various sorts other than symmetrical. It's just, these are being drawn in by a computer, and they don't always get it right. And secondly, you're going to find triangles both at the end of downtrends and at the upside of uptrends. This is a bearish chart formation, and we are looking for them in a downtrend. Now, we are currently in a very strong bull market. In fact, just this last week, here it is mid-October 2013, and the market just hit new all-time highs. So we're not going to find too many downtrends out there. So we're at a bit of a loss on this formation, but I did find one chart that we can look at, and it's on our second page here. I believe it's the chart of Japanese yen. So this is an exchange-traded fund for the yen, and the Japanese yen has been in a downtrend. I'm not sure why, but it has been. I know the Japanese economy is starting to bounce back, but regardless, the chart here clearly shows a downtrend and the price pulling up into a symmetrical triangle. So let's take a look at this chart a little more carefully. So there's our downtrend, clearly we're in a downtrend. We have both the 50 and the 200 just dropping off a cliff. The 50 has pulled into a sideways consolidation. It's more or less going sideways, and that's what you would see in an extended consolidation chart pattern like this one. Let's draw in our trend lines and see what that looks like. We have, always you want to put your initial line over the top, and then your bottom line in a symmetrical triangle should be roughly equivalent to it. So if we run through as many of those lower pivots as we can, then we'll get our symmetrical triangle. It's not exactly symmetrical, but it's fairly close. So how do we play this? Well, we're expecting, because we're in a downtrend that's consolidating, we're expecting a downside breakout. Now, you can play this in one of two ways: the safe way, or the lowered risk but higher failure rate way. The safest way, the most reliable way, is to wait for the breakout itself. Now, this isn't the best chart because this is an exchange-traded fund of a currency, that is a futures market. And you're going to get a lot of overnight gaps in this particular security. You're going to get a kind of a messy-looking chart. If I can just draw in, kind of what we're looking at here. We've got one touch here at the bottom. We've got another touch at the top. I mean, you can see that the zigzag trend lines are pretty clearly mapping out a triangle formation there. And what we're expecting is a downside break. So on any close at around 21, that's outside the lower support line, that would be our signal to go short. That's your most reliable way to play this. Where would you put your stop? You would put it somewhere within the triangle. The lowest risk place to put it would be sort of in the middle of the triangle above the 50-day moving average here, so it would be somewhere around, like, say, 21.75. If you wanted to give it a little bit more room, take on a little bit more risk, you could put it up above the resistance line, which also coincides with the 200-day moving average, so something around 22.45. The less risky but less reliable method is to wait for another touch of the resistance line and then short it at that point. So if this climbs back up to 22, which it seems to be in the process of doing, then you could enter at that point off of resistance, which is very close to the 200-day moving average, which should also act as some resistance. So that's quite a nice place to get short. And then you would put your stop loss just above the moving average there. So again, about 22.45. So you're only risking about 45 cents. Your downside potential, based on the measured move, we're going to measure it in the same way we did last time. Take the middle, which is right around about 20.25, and at the top end we're up at around 23 for a $2.50 move off of the $21 signal place, and that would give you the downside target of about 18.50. Did I do the math right? So, sorry, we don't have too many good examples of that, but it is certainly a very healthy bearish formation chart pattern to work with. So the second of the three bearish chart patterns we're looking at is the descending triangle, or triangle descending. We'll click on that list. A descending triangle has a horizontal support line, but a descending resistance line. So the line drawn over the pivot highs is getting lower and lower, even as the pivot lows are matching more or less the same price point. There aren't too many good-looking descending triangles in a downtrend. Now, we are looking for downtrends on this because this is a break down to the downside of a consolidation following a downtrend. So this is a continuation pattern of the downtrend. And the market's going up right now. We're in that stage of it going up. So there aren't too many good-looking downtrends out there, but there are a few. One of them is Radware. They came out with a horrible earnings warning, lowered their guidance and all of that back in April, and got knocked way down from above 19 to below 15. And they've been consolidating that downtrend ever since, but doing so in a bearish fashion with this descending triangle. So let's take a closer look at that and see how we would play that. So this is clearly a descending triangle because we can put a horizontal line under the lows at around a price of $13.50 and a descending line over the pivot highs, and there we have our triangle. How do we play this? The same way we played the symmetrical triangle. We can play it the safe and most reliable way, or we can play it the least risky but least reliable way. The most reliable way is to wait for a close below $13.50, which is down here at the pivot lows. This is almost a 3-touch low, and the more touches you get on against a support line, the more likely it is to break at the next touch. So one thing we could do is, instead of playing the safe breakout, instead of waiting for the breakout, we could get in early by playing the pullback up into resistance. It is right now in a little bit of an uptrend, as we can see. If we draw a line underneath these lows, it's in somewhat of an uptrend, and it may well pull back into this 1450 to about 1465 area, which would hit both the 50-period moving average and the downsloping resistance line. So a short somewhere in that pocket there, maybe 1460, would be a nice place to go short. And it's low risk because you can put your stop anywhere outside of this resistance line. I would put it actually above this high, this intraday high right here. Not sure what happened news-wise with the company, but something caused everybody to get excited for a few minutes, and then it got sold off back down again. So I would put it like maybe even above 15, or at least like 14.90. I'd put my stop there. And if I'm in at 14.60, that's only a 30-cent risk. That's a very reasonable risk to take. And what kind of target are we looking at? Well, again, we measure from left to right and go somewhere in the middle. And our bottom is 13.50, and our top is up here at about 15.50, so that's a $2 move below 13.50. Gives us a target of 11.50. So here's your play. If you can get up to 14.60, you short it. You put your stop in at about 14.90 or 15.10 if you want to give it a little more room. And you put in your limit order to cover the trade back down at 11.50. That's a very nice profit to risk ratio. So then our final price pattern, chart pattern on the bearish side is the Head and Shoulders top. And I'll just have to say up front, this is my least favorite of the chart patterns. It's an oldie but a goodie. It's been around as long as chart patterns have been around, and that's quite a long time. And when it works really well. But my experience with Head and Shoulders tops is that, for one, it's not always easy to spot them as they're forming. And, you know, one man's Head and Shoulders top is another man's double bottom. And we saw from the Bulkowski statistics that it's nowhere near as reliable as the other two bearish chart patterns. Nevertheless, it's a good tool to have in your arsenal. But here's how I like to play it, to take some of the risk out of it and to potentially increase your reward. Now, let me just first define what a Head and Shoulders top is, and this is actually quite a nicely defined one. Like with the double bottom, I like to see a cleanly defined pivot highs and lows. So I want to see that something that looks like an upside down W, or maybe an M, the letter M, where the middle pivot high is a fair bit higher than the one on the left and the one on the right. It's called a Head and Shoulders, as you probably know. The one in the middle is the head, the one on the left is the left shoulder, the one on the right is the right shoulder, and you draw in this horizontal line underneath the pivot lows. That's called the neckline, and any close below that line is your signal to go short. Now, in this case, it never did close below the neckline, because once you have the right shoulder formed, then you're waiting for it to drop below the neckline. It never did, and it turned back up again. But here's how I like to play Head and Shoulders tops, to take some of the risk out, to increase the profit potential. I like to get in at the upper edge of the right shoulder as long as we are at or near a point of resistance. So you see how FinViz has drawn in this resistance line over the top, because we did have this little pivot high right here. And once that pivot high is in place and we get a few days on either side of it, the computer software is going to draw in that resistance line. So we have a resistance line, and then we also have a moving average, in this case the 50-period moving average, which is now down sloping. Those two things together tell me, go short. Go short. You have the left shoulder, you have a big head, and then you have the pivot into resistance forming what could potentially be the right shoulder. So I like to go short in this area and wait for the signal to appear. If it doesn't appear, then I'm going to get stopped out. I put my stop up above the resistance line or up above the moving average, if that's also what I'm using for resistance, and then I'm out with a very small loss. But if it turns out to complete the Head and Shoulders pattern, and it does give us the signal below the neckline, then this is going to drop quite a bit to complete the pattern, assuming it's a valid pattern. How do you measure the move? You start with the neckline, and you go all the way to the top of the head. So that's where you measure the move, from the head. So this is 60 to about 66. That's a 6-point move. Subtract that from 60, you get 54. Your target is down here at 54. So if I'm shorting it here at about $63, I'm looking at a $9 move, which is a very nice move. Now, this is not a big stock. It's probably not one I would be shorting anyway, because it's kind of a sluggish mover. But nevertheless, That's how you would play it. Let's see if we can find another one here we can look more closely at. Now here's a nicely defined head and shoulders top. So let's look at CPK. So here is CPK with what potentially is our head and shoulders top. Now, it is called a top because we're looking at this as a reversal formation, just as we did with the double bottom. So double bottom is a bullish formation that comes at the end of a downtrend. The head and shoulders top is a bearish formation that comes at the end of an uptrend. So we draw in our neckline, always do that first, something like that, and we can clearly identify the pivot high for the left shoulder, the pivot high for the head, and the pivot high for the right shoulder. So here's how I would play it. Once you have this pivot high defined, which is this long bearish day here that took price down to about 53, then I would be going short here with a stop loss above 55. So that's about a $2 risk. And it would have moved a little over $2 in my favor, so I would have moved my stop down to about break even, and then I would have been stopped out because it didn't complete the pattern. Again, we're in a bullish market. I wouldn't be shorting, especially the head and shoulders top formation, at any time during a bullish market. You can short head and shoulders tops during trading range markets, during range bound markets, during volatile markets, during new downtrends, during the middle of downtrends, if you can find a head and shoulders top. But it's just not one you want to trade in a bull market making all-time highs. What you do have, incidentally, is a nice double bottom, right? You've got your clear W formation here with a lot of bullish stuff going on in the right side of the chart. So that's the head and shoulders top. Sorry we couldn't give you a really good formation there to look at, but I think we do have one in the list that did complete and moved nicely to the downside. Okay, so right here, SKH has this left shoulder, has the head, not a really clearly defined one, but you could call that a head, has a little bit of a right shoulder, and again, I would be shorting it right in here, in this little pocket up against the downsloping 50-period moving average, up above 650. And then you can see it just got slammed, and it continued on down. So this was a very nice complete pattern, which would have made, gosh, if you had shorted it where I suggested up above 650 and held it down below 450, you're looking at a nice, I don't know, 30% trade there. So that's a beauty. So we come now to part 3, the only thing you need to know from Elliott wave theory. Okay, so here we are at a chart of the S&P 500, and this is for the year 2013 to date, through mid-October as of this recording. And we can see that the S&P 500 is in a nice uptrend. In fact, it's in a picture-perfect uptrend, a 45-degree angle uptrend, which we could discern by putting an angled line from the lower left-hand corner to the upper right-hand corner. And if we were to draw in that line, we would see that that line would nicely intersect the vast majority of the price action. The price action is moving up at a 45-degree angle. Anything greater than 45 degrees tends to peter out. Anything lower than 45 degrees has a tendency to roll over to the downside. 45 degrees is a nice sustainable uptrend. That's what we have here. Now, with Elliott wave theory, you have a way of discerning where we are in the uptrend and what price is likely to do going forward. Now, there's a lot to Elliott wave theory, and I'm not an Elliott wave theorist. I'm not even a proponent of it. I'm not sure it's one theory that's worth studying. However, it does have a key insight which I think is worth learning and which I use in my own trading. And I'll show you how I use that insight here on this chart. Let's first draw in the various moves that the chart is making, and we can do that very easily by overlaying the zigzag function on the chart. So the zigzag function puts in the major moves of the market. Every time you get a pivot high or a pivot low, it reverses that. It gives you a zig rather than a zag, or a zag rather than a zig. Not sure how that works, but in any case, you get the idea. And the key insight of Elliott wave theory is this, that any major move in a trend, either up or down, occurs in 5 distinct waves, or movements of price in the same direction. In an uptrend, you're going to get 3 waves up and 2 waves down. In a downtrend, of course, 3 waves down and 2 waves up. After you get the 5th wave, in an uptrend it would be the 5th up, the third of the 3 up waves. After you get that 5th wave, then what we expect it to find is a more complicated and more prolonged pullback, which usually occurs itself in about 3 waves. 2 waves down and 1 wave either up or sideways. So that's called an ABC pullback. So you have 5 waves which eventually push price up, and then you have 3 waves which will ultimately pull price down into a pullback. So we can see that clearly here. If we start counting here right at the beginning of January, prior to January, price was pretty choppy and in fact was in a bit of a downtrend prior to December. So we have our first up wave, 1. We have our first pullback, wave 2. Second up wave, 3. Second pullback, wave 4. The last stretch up, which is wave 5. After you get wave 5, you expect to see an ABC pullback, and that's exactly what we got, an ABC pullback. Now, where we are presently is we're in another move up, a measured move up, wave 1 up, wave 2 down, wave 3 up, wave 4 down, and here we are at wave 5. We don't know where wave 5 is going to end, but now we know that since we're at wave 5, the next move down should be a more complex one, a more prolonged one, and will likely take price down lower than a simple pullback. So what we're looking for going forward, what we expect to find going forward, is an ABC pullback. So 3 waves down, 2 waves down, 1 wave either sideways or slightly up. Now, how do I use this in trading? Very simply. If I can determine where I'm at in that wave count, and of course, if you know Elliott wave theory, that's the big trick. And that's the problem I have with it. How do you determine, are you in wave 3? Are you in wave... one man's wave 3 is another man's wave 5, and so on and so on. But if the waves are clearly defined as they are in this case, then you can determine, if you can determine where you are, wave 3, wave 5, wave 1, you'll know whether to buy the pullback. So, for example, if I'm in wave 1 and prices start to pull back, I'm definitely a buyer of that pullback because I know I've got at least 2 more waves up before I get a significant sell-off. If I'm in wave 3 and I get a pullback, I'm still going to be a buyer because I know I still have 1 good leg up before I get a significant pullback. But if I'm up here at the end of wave 5 and I see price starting to pull back, I'm not going to be a buyer there, because I'm looking for something a little more complicated. I want to see a good ABC pullback, which may take several weeks, if not months, to develop. And once we get that, then I'll start to look again at going long at least this index. Now stocks, individual stocks and other sector indexes are a whole different story, but we're just talking here about this particular chart. The other thing that you want to note, that if you are a breakout trader, you want to buy breakouts of wave 1, and wave 3 also is a good place to buy a breakout, but you certainly don't want to buy a breakout on wave 5. Okay, so that's it. Just 1 point on Elliott wave theory. End of part 3. Section number 4, 3 key technical indicators. We're going to look at the Commodity Channel Index, or CCI. We will be looking at the overlay Bollinger Bands. And finally, we'll also talk about on-balance volume, or OBV. All right, so here we are with a chart of the S&P 500, and we'll be talking here first about the CCI indicator, the Commodity Channel Index. In Chart Reading 101, we looked at the MACD indicator, moving average convergence divergence, along with moving averages and the stochastics indicator. And I gave you a very simple but very effective trading strategy that you can use with those indicators put together. We're going to move on from there and add 3 additional indicators, and this completes the package of indicators that I ordinarily use on all of my charts. I occasionally will refer to other indicators like RSI, Relative Strength Index, or rate of change, and so on. But these are the 5 principal indicators, along with moving averages, that I use every day to analyze technically the charts that I will buy or sell. Here we have the S&P 500 with the CCI set down below, and it is set at the default periodicity of 20, which is just fine for our purposes. I never change that for any reason. The CCI is built around an average of price, that is a one-day average of price, high, low, and close divided by 3, relative to a moving average of price, which is the 20-period moving average. That's the periodicity of 20. And then a standard deviation and a mathematical constant is thrown into the mix for good measure, and we get the CCI indicator. When the CCI is above the 0 line, that indicates that the average price for the day is moving above the 20-period moving average. And if CCI is trading below the 0 line, then it is moving down below the 20-period moving average. So I use CCI for 2 reasons, to determine 2 different things. The general market direction, in other words, are we in a bear market, are we in a bull market? And then I also use it for timing my entries into timing my buy entries in a bull market and my sell short entries in a bear market. So to determine general market direction, I scroll up to the weekly chart, which we see here of the S&P 500, and with only the CCI indicator on the chart, my reading of it is that anytime the CCI is above this 0 line, we are in a buy the market mode, and anytime it drops below the 0 line, we're in a sell short the market mode. And I hesitate in calling these bull markets and bear markets because those are indications that are used for longer term cycles. And so if the CCI is telling me to sell short the market, it doesn't necessarily mean we're in a bear market. It just means that for the next few weeks, we expect there to be higher volatility and more money is likely to be made on the short side of the market. So if we annotate this a little bit, let me show you what this looks like. So we see anytime the CCI indicator is above the 0 line, as it is in this area here. It's kind of a light green. Let me see if I can darken that a little bit for you. There we go. So anytime it's above the 0 line, we are in an uptrend, and we want to look at going long for the most part, if not predominantly. And we can see several periods where here's a very narrow little period. It only includes a few weeks there. But then we have a much larger period here. Bull market, I shouldn't say bull market, an uptrending market here, and then pretty much the whole of 2013 to date is an uptrend. So these are all periods on the weekly chart that I would say, hey, let's go long. And anytime we're in between those, see all this volatility here in, this is the latter half of 2011, and right here in the middle of 2012, and right again at the end of 2012. Now it doesn't catch every little downturn exactly right, but it'll get you in pretty closely, and it just gives us a cautionary tale saying, hey, let's lighten up on the longs, let's consider putting on some hedge positions, and maybe let's outright short some stocks during that period when the CCI is below the 0 line. So that's one thing that I use it for, to determine general market direction. The other way I use it is on the daily chart. Here's the daily chart of the S&P 500 with the CCI. And we know that for all of 2013, so far at least, the market has been in an uptrend, in buy the market mode. So when I scroll down from the weekly chart to the daily chart, what I can do is look for those extreme readings below the below the negative 100 line on the CCI, the sharp dips below that level for nice entries into the market. So we can see that the market here gave several nice buy signals according to CCI. You want to only do buy signals at this point. You're not even looking to go short because from the weekly chart we know we're in a bullish period. So here, late February, we had a buy signal period right here. We had another signal here mid-April, coincides with that low. We had one early June, which is a little bit too early because there was further downside. So that's a signal that we might say, oh, it's not a good one. And that's why you use stop losses. But here we have an excellent buy signal toward the end of June. Very nice catching this low right here. And then in August, we have the lowest CCI reading touches negative 300 mid-August, and it coincides with this low right here. There was still a little bit further to go, but that's pretty close to a nice buy point. It went from like 1640 to 1760. So, and then one more here early October. See how it catches the lows quite nicely. And so you can use CCI in two ways. One, to determine general market direction. Secondly, to determine your entries on the daily basis. And if used in conjunction with other indicators like oversold stochastics, and we'll see the Bollinger Band here in just a minute, it's an excellent tool to get us in at the right time. So indicator number 2 is the Bollinger Band. Bollinger Bands are an overlay, which means we put them on top of the price chart so that we can see how they interact with the ongoing price. Again, we'll stay with the S&P 500. And we use Bollinger Bands I use it in two ways. One, like the CCI, to help me determine entry points. And secondly, I use it also to help me with my options trading. And I'll show you how that works in just a minute. So Bollinger Bands are a development of a guy named John Bollinger, named after him. He's an interesting market technician. He's one of the few, like myself, who combines technical analysis with fundamental analysis. But his greatest contribution to the world of technical analysis are his bands. They're actually a development of a couple of previous attempts at the same thing. There were Keltner channels, and then there were Donchian channels. And Bollinger Bands, the most sophisticated of that evolution process, and certainly the most reliable, the ones that I use quite regularly. So I always keep a set of Bollinger Bands overlaid on price because they will tell me when price has gotten a bit too extended. With the Bollinger Bands, you have three pieces of information, actually several more than that, but we'll focus on three. One is the 20-period moving average, which you have in between the two Bollinger Bands. And the Bollinger Bands are measuring the standard deviation of price above and below the 20-period moving average. And that's an absolute value, so whether the price moves above or below, the bands will expand as price moves further and further away from the 20-period moving average, and they will contract as price pulls into the 20-period moving average and hovers around that level. So anywhere the bands get pinched, as they do right here, very narrow bands, you have a period of consolidation, you're expecting a pretty sizable move after that. And anytime you have very wide-ranging bands, as you do here, you've got strongly volatile movement, strong price movement, trending either up or down. For me, Bollinger Bands are important for this very reason. Whenever price extends outside of the Bollinger Bands, particularly when the bands are at a wide point, not narrow, not when they're pinched, but when they're at a wide point and I get trading outside of the Bollinger Band, that is, for me, important information. That tells me that price is getting a little too far away from its 20-period moving average. The 20-period moving average is now going to act as a magnet. It's going to pull price right back up to it. Doesn't always work that way, but in most cases it does. So whenever you see price closing outside of a wide range Bollinger Band, particularly if you see it skirt way down like this, right, way far below the lower Bollinger Band here, you know that you've got a trading opportunity there because price is likely to snap back up into the 20-period moving average. if not completely beyond that. And sometimes you do get nice extensions beyond. So here's another case where price is closing outside of the lower band. It makes a nice long extension, nice long lower shadow candlestick here. And that, if you can get down here at this low, that's a very nice entry. You're going to get a nice snap back up to the 20-period moving average, and in this case it went beyond. Now the same is true also for closing outside of the upper band, but as we know from the CCI analysis, we're in an uptrend during this part of the market. This is 2013, and so you're not necessarily looking for ways to go short this market. But I will give you an exception to that rule, and that is what I call my 3-day rule. My 3-day rule on Bollinger Bands is that if you have 3 closes outside the Bollinger Band, either the upper band or the lower band, the 4th day after the 3rd close outside the band is almost always going to be a reversal day, a reversal back inside the bands. And it doesn't mean that you'll always get follow-through. It doesn't mean you're going to get a complete reversal of the trend. Sometimes you just get some sideways consolidation. But after 3 closes outside the Bollinger Band, you very often, 9 times out of 10, I'm venturing to say, you will get, on the 4th day, a sharp reversal. And so you can almost always fade the close of the 3rd day outside the upper Bollinger Band or buy the close of the 3rd day below the lower Bollinger Band. Now, one caution, that does tend to work best on the indexes and your exchange-traded funds, which are baskets of various stocks, and it doesn't work quite as well on individual stocks themselves, but it nevertheless does work well. You just have to employ other indicators to make sure you're getting into a decent trade. So remember the 3-day rule. 3 days outside of a Bollinger Band is very likely to cause a reversal back within the Bollinger Band. You can actually create a scan for that 3-day rule, and I'll show you what that looks like here. I created one in StockCharts.com. You can also create a scan in Metastock or NinjaTrader, whatever you're using, and I call it my 3-day Bollinger Band rule. And if we run this scan, I ran it earlier just a little bit ago, we ended up with a very large count of stocks. 162 stocks are currently passing this scan, which says, after a certain price level and a certain volume level, that they are currently trading on the 3rd day outside of the Bollinger Band. We'll take a quick look at Apple here. Of course, that's a very popular stock, popular company. And you can see here we have 1, 2, 3. Today is this day. We're actually in the middle of trading right now. It's about 1 p.m. in the afternoon. And Apple's not having the best of days here after a very strong run up. And this is the 4th. This is actually either the 4th or 3rd. I can't tell if that day closed outside. It looks like it did. So this may well be the 4th day up on top of the Bollinger Band, and this would be your reversal day. If you had shorted the market at yesterday's close on the 3rd day outside, you're looking at about a 521 entry, and it's now trading at 516. And it very well may pull back into the 500 or below level. Here's your 20-period moving average here at about 493. So you might get a nice little 4 or 5 day 20-point move on Apple, which is nothing to get real excited about, but if you want to trade that way, that's fine. So anyway, I just wanted to show that to you. Let's go back to our chart. And so we have the anytime price closes outside of the lower band, particularly when the bands are wide, and then you have an area in which to consider going long. And whenever price closes above the wide range Bollinger Band, the upper Bollinger Band, you have an area in which to think about going short. Now, again, you'd want to confirm, especially on the short side, if you're shorting a bull market, you want to confirm with a number of other indicators to see that that's a good trade. But certainly in a bull market, these lower closes outside of the Bollinger Bands are really, here's one down here in late February, a very nice place to go long. And remember, we also had confirming CCI indicators, buy signals there at those points. So, all right, so those are a couple of ways to use Bollinger Bands. Let me show you one additional thing you can do with Bollinger Bands. And that is you can put an indicator on your chart, which is the Bollinger Band width indicator. which looks something like this. It's just a single line, and it'll roll up and down like a roller coaster. It goes up whenever Bollinger Bands increase in width, which means that price is moving further and further away from the 20-period moving average, either up above it or below it. And the BB width indicator will fall. It will trend down whenever the bands are tightening. Now, if you're an options trader, and like I am too, then this is important information, because as the Bollinger Band width is increasing, that also means the volatility of that stock or index is increasing. And as you know, implied volatility is one of the factors that determines the price of options. So whenever we see the Bollinger Band width rising, as we do here in this period, that's a time when options are getting more and more expensive. It's a great time to be an option seller. And that's something actually I prefer to do, because you'll make more money selling options than you will buying options, because most options expire worthless. I don't know, 80–90% of them expire worthless. So if you can find the right option at the right price, you can make a lot of money consistently by just selling options short and holding them till expiration. And as long as they expire out of the money, you can keep the premium. So you want to sell options short when the line is rising up. And when the line is coming down, that implies that volatility is falling, and your options are going to get cheaper and cheaper. And so when it falls down to a certain point, kind of relaxes here, that's a good time to be a buyer of options. Options are much cheaper at that point, and volatility is almost always likely to pick back up again. It always does after a period of consolidation. And so then your options are going to increase in value quite a bit after that. So just remember, be a buyer of options when the width is low, and be a seller of options when the width is high. Now, the last indicator that we want to look at is a volume indicator called on-balance volume. So here we have a chart of the S&P 500 index again, and I've removed the Bollinger Bands, and the Bollinger Band width indicator I've placed now the on-balance volume. And what I like to do normally is to overlay a simple moving average onto the Bollinger Bands. I like to use the 21-period moving average, and so we'll update with that. There we have it. The 21-period moving average of the on-balance volume smooths out the little choppy bits of the average, and as long as you have a rising moving average of on-balance volume, you have the confirmation of an uptrend, and then a flat 21-period moving average is normally a period of consolidation or pullback. So I use on-balance volume in one of two ways. I use it first to help me confirm breakouts. I don't want to buy a breakout, that is to say, when price is moving above an area of consolidation or above a prior price high, if on-balance volume is not moving along with it. So sometimes price will rise out of a period of consolidation or above a previous resistance point, but on-balance volume is trailing behind for whatever reason. It just means that you don't have as many buyers supporting the breakout move as you had sellers during the previous pullback or during the previous period of consolidation. And that's not a confirming trend of the bullish breakout. So I use on-balance volume to confirm breakouts. Let me show you what that looks like. So here we have this period of consolidation after a nice little run higher, and then we have a little thrust of price higher, and I'm wondering, do I want to buy that breakout? I look down at on-balance volume over that same period, and I see that, okay, I see on-balance volume consolidating around the 21-period moving average. That's okay. But as price is breaking out to new high, on-balance volume is not breaking out to new high. It looks like it's pretty much the same high as before. If I can get that, come on there. There we go. So that's really a horizontal rise in on-balance volume. It's not rising to a new high. I'm not going to buy that breakout. Turns out I was right. On-balance volume, I should say, was right. But then we have a pullback, and then we have a further spike in price up there, which forms this new high. And I'm wondering, hey, do I want to buy this breakout? And the answer is yes, because now we have this nice rising on balance volume to new highs, and that's very bullish. That's confirming the breakout. So you want to buy it right here about 1600, and you could ride that all the way to the top. Once on balance volume starts to break that 21 period moving average right about there, then you have your indicator to get out of the trade. All right, so use on balance volume to confirm breakouts. I also use on balance volume to determine whether I should be buying a pullback. Let me show you what that looks like. So here we have this uptrend, right? We have a nice little uptrend moving all the way up, all the way up. And then we have a little pullback, which may in fact be, you know, one of those ABC pullbacks we talked about before. And I'm wondering, I like to buy pullbacks. That's one of my favorite trading systems. I call it the pullback setup. Talked about it in Trend Trading for a Living, that first book. And the key is you find an uptrend and then you buy the first pullback off the uptrend to a place of support. Well, here's a nice little pullback on this kind of new uptrend after a period of consolidation. Do I want to buy it? Well, if I look at on balance volume, what I want to see is on balance volume at the very least staying up near or above the 21 period moving average, and this is pretty much staying below it. So that's telling me that this pullback is a sharper one than would be expected, and there aren't as many buyers as there are sellers, and this is an area of distribution. A lot of shares are coming off the table in this index, is the S&P 500. And so this is a period I'm not going to buy. I'm not going to buy this pullback because I'm not getting a confirmation from OBV. And it turned out that OBV, again, was right. When do I buy the pullback? I want to buy it. I really want to buy it. I just need to wait for the right signal. Well, what's the right signal? The right signal comes right here when OBV closes above the 20 period moving average and stays above it, right here at the end of June. The end of June corresponds with this little 3-day, this little white soldier rally. And, you know, sometimes these little rallies after a sharp downtrend are a form what are called relief rallies, which are, you know, short covering rallies that don't last very long. But because on balance volume is closing up above its 21 period moving average, my thought is that's a reversal of trend. And buyers are now stepping back on board, and big money is coming back into the market after this nice 6-week pullback, and that's a trend I want to buy. So I'm going to get on board with that, and then we don't get a sell signal until right about here, early August, which is this little period of consolidation, a little distribution right there, so we would get out at that point. We'd be buying the market around 1610, we'd be getting out right around 1690. That's a nice run. Again, we have a pullback. Do I want to buy the pullback? Like right in here, you know, it looks kind of like, is this a place to buy? Whoa, you know, it's pulled back to a 1640, and I've got a couple little green candles in here. It looks like a nice little pullback area, but I look down at OBV, and OBV is telling me no. OBV is telling me stay out because it's not above the 21 period moving average. Where does it cross above the moving average? It crosses right here, right at the beginning of September. And so this little run here in September is the buyable place. That's where you want to buy the pullback. And it turns out, you know, I saved myself a couple of weeks of holding onto shares that would have been, for the most part, below water. And I got in, okay, maybe I got in a little bit higher than I wanted to, but it's a much safer entry. And it runs from 1655 up to 1725. Nice run. Again, another pullback. Do I buy? Do I buy? No, I don't buy. I don't buy. I don't buy until I see this right about in there, and mid-October, which coincides with something around that period, and that's where you would want to buy. And again, we're still in the midst of that uptrend. Okay, so those are the three indicators: CCI, Bollinger Bands, and OBV, and for the most part, how I use them. Let's move on to the next section. Section number 5, using candlesticks to pinpoint trend reversals. We're going to be looking at 3 forms of candlestick types. We're going to look at hammer candle reversals. Secondly, what I call long reversals. You'll learn what that means in a little bit. And thirdly, long, short, long reversals. Before we start looking at charts, let me give you just a very brief primer on what a candlestick is. you know what a candlestick chart is from Chart Reading 101, and you also then know that the candlestick itself conveys 4 pieces of information. The horizontal line here in this white candle at the bottom is the line for the the line for the open. The horizontal line above it is the line for the close. We know this is the open and this is the close because it's a white candle. In some cases it'll be a green candle. White or green candle means the close is above the open. The little tail at the top here is where price traveled to the intraday to its high of the day, and the little tail at the bottom is the intraday trading down to the low of the day. So again, open, high, low, close. In this case it's a black candle. Sometimes you'll see a red candle. So we know that the open is above the close below the open. So again, open, low, high, and close. If you want to have a very thorough primer or introduction to candlestick formations, I suggest going to the Chart School on stockcharts.com. You'll find a whole list of candlestick formations there, as well as a 5-minute video presentation that would give you a very decent education on candlestick formations. If you really want to dig down deep into the formations themselves, you'll need to look at Steve Nison's work, Nison. He's the guru of candlestick formations. He has a very lengthy DVD course that I took some years ago. It is worth it. It's worth taking. It's a bit time-consuming and heavy on information, but very, very thorough. Now, with that behind us, I want to say that I think that with the exception of the 3 formations I'm going to teach you here, candlesticks are best left behind, or best forgotten. Candlestick formations are best left untreated. No, don't even worry about them, and I'll tell you why in a little bit when we get to the charts. But let me show you my 3 formations. When we're trying to find reversal pivot points, and that's kind of what we've been doing mostly in our webinar here, candlesticks can give us one additional tool in our arsenal that will help us pinpoint the reversal. So at the end of a downtrend, we know when to buy, expecting it to reverse back to the upside, and at the end of an uptrend, we know when to sell short, expecting then stock price to fall. And one of the better formations, candlestick formations, to help determine that exact pivot point is the hammer candle. Here we see on the left side of our screen the hammer candle. If you find one of these formations, whether it's black or white, red or green, doesn't matter. If you find one of these candlestick formations at the end of a long downtrend, and a sharp downtrend, not one that sort of chops around sideways for all, but one that drops steadily down, and then you see one of these candlestick formations, that's a bullish reversal candlestick. That's an opportunity to buy that stock. Over here on the right side, if you see one of these formations, black or white, it doesn't matter, at the top of a long uptrend, a significant uptrend, and a sharp uptrend, and you see one of these guys at the top, that's a sign that the bulls have run out of steam, the bears are taking over, and that's a good sign to go short. So we'll look at some examples of these. And then here's what I'm calling a long reversal, and these come in various forms. Sometimes they're called piercing candlestick formations, sometimes they're called harami, and there's some other Japanese names that I won't worry you with. But essentially what we're looking for is for a bullish reversal. So in other words, at the end of a downtrend, you want to see a long stick, either red or black, followed by a long stick, white or green. You don't want to see much in the way of tail formation at either the top or the bottom. You can see a little bit, that's okay, you just don't want to see much. You want the body of the candlestick to be nice and long, covering, I would say, at least 80% of the candlestick. So you want to see a long black candle followed immediately by a long white candle. You put those two together at the end of a downtrend, and you've got your reversal formation. Don't worry about this. It's telling us that these two candles together equal a hammer candle. So that's one of the reasons why it is so effective as pinpointing a bottom. If you see this formation on the right side at the top of an uptrend, then you have a reversal formation. You're expecting a pivot to the downside. Long white candle or green candle with very little tail at the top or bottom, followed by a long black or red candle with very little tail at the top or bottom. That's an indicator. You see these two together at the top of an uptrend. That's a time to go short. Now, the way these pictures have it doesn't matter whether the candle is a little bit above or is engulfed by the other. It doesn't matter where they're positioned. All we're caring about is that we have two long candles, long formation, in opposite directions, and that will give us the reversal. On the next slide, I had to show a chart for this one. I couldn't find a decent graphic for this formation. This is the morning doji star formation. It goes by a couple of other names too. It doesn't really matter. I just call it the long, short, long reversal, just to make things a little simpler. So if you have, at the end of a significant downtrend, a long black or red candle, followed by a little short candle, this is a doji. A doji is a candlestick where the close and the open are really close together, sometimes identical, and that's why you have just what looks like a single horizontal line right here, because that single line is representing both the open and the close. And it's a short candle, so there's not really a lot of length between the high and the low. It was a very narrow range day. And it doesn't have to be a doji. You can have this whole candle filled in with a body as long as it's much shorter than the other two. And on the other side, the third candle, this is a three-candle formation. You've got a long-bodied white or green candle. If you see those three together at the bottom of a downtrend, that's a signal to go long. You would want to go long at the close of the third candle of that formation. I don't have the opposite on the bearish side, but if you just reverse the order of the candles 1 and 3, you'll have the bearish formation. So you would have then a long-bodied white or green candle, followed by a little short candle in between, and then a long-bodied black or red candle. If you see that at the top of an uptrend, that's a signal to go short. And again, it doesn't matter where the second candle, where the short candle is. It can be down here at the bottom, up at the top, or somewhere in the middle. Doesn't matter. As long as you have those three, long, short, long, and the two longs are in opposite directions, and if they're placed at the end of a downtrend or the top of an uptrend, you've got your reversal candle formation. Now, in my opinion, those are the only three candlestick formations that make any sense. They all make sense to some degree, but these are the only candlestick formations that I have found, for my money, consistently, reliably point out reversals in either downtrends or uptrends. So those are the only three I'm going to teach here. So here we are at the finviz.com site. I wanted to start here because the site has a nice screening tool that you can use to find stocks that are showing specific candlestick formations, in addition to other things, including both technical and fundamental parameters. I want to build a very simple screen here that will look for stocks that have recently trended up, but are then showing a inverted hammer candle at the top of that uptrend. Let's see if we can catch a trade or two using this simple screen. So under performance here, I have the week has been up. Under price, I have over $5 per share, so we cut out the penny stocks. Over 200,000 shares per day, so it's not too thinly traded. And you could, mess around with these figures as you see fit. And then over here under candlestick, we see both hammer and inverted hammer. Now, you can use finviz.com to screen for those first two formations that I mentioned, but you won't be able to use it for the long formation or the long, short, long formation, but we'll use another tool for that in just a moment. So let's put on inverted hammer, and you can see our screen came up with 9 potential stocks, but of course not all of these will fit our needs. So let's just take a quick look at the thumbnail sketches. Here is CETV, and we can see that it has been trending up. We do have a bearish inverted hammer candle right there that closed down into the body of the previous day's candle. And you can see also that volume is above average. So that actually looks a bit on the bearish side, but it's not the extreme uptrend that I would like to see, so I would probably pass on that. This looks a little better. EIX is also showing a bearish inverted hammer candle after a fairly solid run off of the pivot low around 44. Volume, however, is kind of light and actually declining up here. We are pulling into an area of resistance around 50, so that's also bearish. But it's not the nicest looking formation out there. Now this one actually looks interesting. And I like this best because we have a very sharp uptrend off the October low of 40. And then it ran all the way up on a false breakout tagging 47 on the inverted hammer candle and on very strong volume. Let's take a closer look at that. And you can see that price on this last day here ran up above the 50-day, or sorry, that would be the 200-day moving average. And then the bears took control from about 47 all the way down to near 45. And that was on strong volume. That, to me, looks like it's going to roll back. Now, it may not pull back much further than the 50-day moving average, which would only be about, I don't know, $2 move. But it may also pull back even further than that, but you never know. So anyway, that's how we play the inverted candle. Let's go back and do the same thing with the hammer candle proper, which is normally found, we'd like to find it, at the end of a downtrend. So this time we're going to switch to weak down, keep the other two parameters the same, and switch inverted hammer to simply hammer. Here we have four choices to look at. DGX, well, there's a little bit of a hammer down there, but that's not really a downtrend. That's a gap down, so we'll pass on that. GoGo, interesting name for a company, is not really showing much of a hammer. That's kind of a false positive there. MTB, which is a regional bank, we just see it here as maybe a 3 or 4 or 5 day sell-off off the 116 level, and it is showing a nice little hammer candle on above average volume. So that's a possibility. And SONC, oh no, that's not really much of a downtrend. So MTB is our closest possible choice here. You want to see a longer downtrend than that. 3 to 5 days is really not significant enough. But it does go to show you that you can get these nice little hammer candles that might in fact pop up for a couple of days back into the 115 resistance area for about a $2 trade. But it's not really one I would take. But anyway, that's what we're looking for. What we're looking for in a case like this is something like the candle we see right here a little earlier, after a significant downtrend off the highs around 118, pulling all the way back to 110. We get at a level of trend line support. We get this hammer candle. See that hammer candle right there? And if we go down, we can see volume is more or less above average. These little green spikes here and the red spike there, all above average volume, which is positive, and so that's a buyable pullback right there, and you get a nice little 4-day thrust up, about a 6-point move if you caught the end of that. So here we are at stockcharts.com, and we're going to use this site for the second and third candlestick formations that we talked about, the long and the long-short-long. And I'm going to go to our list of scans that I've programmed in here over the years. And somewhere in here we go, I have a long scan. Now I only have this set to find the long candlestick formation. I don't have it set to find, up one day, down the next, or at the end of a downtrend or at the end of an uptrend. You can do all that, but just for the purposes of our time today, I left those further filters out so that we get at least a handful of stocks coming through the scan. You're going to find when you scan with the rest of the filters in there, you want to scan for a downtrend with a long red candle followed by a long green candle, or you're going to screen for an uptrend with a long red candle, a long green candle followed by a long red candle. When you set the filters with those specific parameters, you're only going to get 1 or 2 stocks coming through, and maybe not even every day, depending on market conditions and so on. Maybe 1 or 2, 3 a week is fine. So for purposes of our time today, I just wanted to run the scan without those further filters in there. and take a look at what we've got. Here we have 9 stocks that came through the scan. I already have them in a watch list, but let's go ahead and put them in a watch list. We'll just do it just briefly here, and then we'll look at these charts one by one. And here we do have a nice downtrend. We have the, except instead of a red candle, green candle, we have the opposite. So that's not a valid signal. Here's something that is possible. This is DUST, the bear leveraged 3 times ETF for the gold mining index, the otherwise known as GDX, the Gold Bugs Index. List of mining stocks, gold mining stocks mostly. And this is clearly a very sharp downtrend, which started up around 44 and hit a bottom around 28. That's very sharp. Now this is a leveraged ETF, and it moves very fast, very sharp. And we have the requisite long-bodied red candle, followed by immediately a long-bodied green candle. That right there is your bullish formation. That's exactly what you're looking for. The fact that it's outside of the lower Bollinger Band, all the better. The fact that if we can look up here, CCI is below negative 100, so much the better. The volume's a little light down here on this kind of formation. You want to see real heavy volume above average. We have one day, the down day is above average. The green day, which is your better, the important day, is not showing above average volume. So a little bit of concern here, but I would suspect we're going to get maybe a 2 to 3 day pop in DUST, maybe going into the 33, 34 area, clearing that that gap and maybe filling that gap. So then let's go back and look at the other scan, which is the long, short, long, which is right here. And if we run that scan, we only have one stock. We only have one stock on the list. So let's take a look at that. And this is a, now we're looking for long, short, long. We don't have anything like that here. So this may have been a false positive. And no worries, not going to worry so much about that. Let's see if we can find a long, short, long on the chart, though, because that's always a good example. We have something like that. We have a long, green-bodied, white-bodied candle here, following, a nice 10-day run off the bottom of 45 to a top of 57.50. That's a nice run. And we have long. We have a little doji. And then we have a relatively long red candle. That's not the kind of long red candle you want to see. You want to see that long red candle significantly longer than the short candle in the middle. So that is not quite giving us what we look for. So let's take one more look at the S&P 500. This is the spider, because there are a couple of nice candle formations on here. It's always a good thing to test yourself to make sure you understand what I'm teaching. So, and the best chart to do that with usually is the S&P 500, because you're going to get all kinds of interesting formations on it, as opposed to individual stock companies, which can have all kinds of gaps and heavy volume, long body days that just kind of ruin the look of the chart. But you get a lot less of that in an index chart like the S&P 500. Right off the bat, I can spot here a nice bullish hammer candle reversal. So we have the downtrend here significantly closing below the low of the lower Bollinger Band with a nice hammer candle. Volume is above average. This is one we looked at previously. We know that OBV is not quite where we would want it to be, but you can override that when you've got a nice candlestick showing right there. With hammer candle is normally very bullish at the end of a downtrend, and when it's showing high volume as well, all the better. So you could have gone long at the close of that day for a nice run up. But also note that we do have right here, we have the long, short, long formation that we were looking for, the 3-candled formation. Yes, there's a little gap in there, but that doesn't matter. The formation is long-bodied down, short candle in the middle, followed by a long-bodied candle up. And those three candlesticks together tell us that we're likely at the end of that downtrend. So you could have bought it on the hammer candle, or you could have bought at the close of the third candle, that long-bodied white candle. What else do we see on the chart? Here's another long, short, long. We have a long white-bodied candle at the top of an uptrend. We have this little piercing candle at the top that's actually outside the Bollinger Band at the open, and then inside the Bollinger Band at the close, followed by a nice looking long-bodied red candle. That's a bearish top right there. So long, short, long on the bearish side, long, short, long on the bullish side, plus the hammer candle. All that's looking quite good. Here's another sort of quasi-hammer candle. And with a hammer candle, you want to see the close and the open near each other, number one. Number two, you want to see a long tail at the bottom. And number three, you want to see close and the open somewhere in the upper third of the candlestick. And I'm not sure if we're quite there. We might have it in the upper 40% of the candlestick, but not quite in the upper 33rd percent. But it's pretty close in any case. So that's the kind of thing you're looking for, more or less. Very strong volume there. It's not much of a downtrend here, really. It's just a 3-day drop. But it does signal, especially outside the lower Bollinger Band, it does signal a nice reversal pivot. Okay, so that's it on our brief run through of the three candlestick formations that I consider to be the most important. The hammer, the inverted hammer, the long, long, and the long, short, long formations at the bottom of significant downtrends and at the top of significant uptrends. When you spot those, in addition to the other indicators that we've talked about, then you've got something you want to jump on. Load up the boat, back up the truck, mortgage your house, and put it all in the one stock, because that stock is very likely to move in the favored direction. All right, on to the next section. Section number 6, using the chart to determine stops and target exits. So here we are again at the S&P 500, and this time we're using the Metastock charting tool. Metastock is a research tool that's been around quite a long time. And a couple of years ago, I partnered with them to produce the Dr. Stocks Trend Trading Toolkit, which is a very large package of features that give you scanning tools. All the scans that I have, all the trading systems I have in my first 2 books are located there, and as well as guidance on when to get in, when to get out of different trades. It will give you real-time signals of new trades as they happen in real time. You also have some charting templates, and you have some backtesting features. It's just a really cool tool to use. I do have a discount link I can send you if you're interested in that, but I don't want to plug that here. I just want to let you know that that's available. Here we want to talk about setting stop losses and target prices for when the trade either goes against you or in your favor. You do want always, before you enter any new trade, to know exactly where you're going to put your stop loss and where you will put your target exit. And the reason why you want to know that ahead of time is because you need to determine if this is a good trade to take or not. And that's done by looking at the ratio between the anticipated loss if the trade goes against you to the anticipated gain if the trade goes in your favor. For example, let's say you're buying a stock that's around $10 per share, and you've determined that the upside potential of this trade is to about $11 per share. You think at $11 it's going to peter out, it's going to hit some resistance and turn back and start pulling back. So $11 is your profit target. And then you also determined that this trade could probably go down to a little over $9 per share and still rebound and hit that $11 target. So you're going to place your stop loss at around 9. You're taking a 10% risk to make a 10% gain. Now, that's not a good, risk to reward ratio. That's a 1-to-1 ratio. You want something much closer to 1.5. In fact, that's kind of a minimum. You want at least 1.5. 2.0 is even better. 2.5 is probably about as good as it's going to get. Anything over 2.5 and you probably have your stop a little too tight, or you have your target a little too far away from present price, and you're not going to maximize your profit over time ratio. That's a second ratio that we won't talk about here, but both of those you need to keep in mind, the risk to reward and the reward to time ratio. So to maximize both of those, you need to know where your stop is and where your target is before you get into the trade, and that's going to help you determine whether the trade is worth taking. If you scan through, if you run a scan and you end up with 15 or 20 stocks, you obviously can't trade them all. So you're going to weed out the ones that have the lower risk to reward ratios, and you're going to consider those that have the best risk to reward ratios. And even when all the other things are in place, it's got great technicals, it's got a great breakout pattern, or whatever it is you're trading, it's got strong fundamentals on the upside, and it has a lousy risk to reward ratio, you're still going to pass on that stock. So having said that, let's look at the best way to set stops and targets. There are really three ways of setting stop losses and targets. I talk about all three of these in my first book, Trend Trading for a Living. I won't talk about the percentage system, where you just set a straight percentage stop loss and a straight percentage target. That is okay, it's good, but it's not the best. A better system is to use the average true range, ATR, which is a technical indicator that you'll find in all charting packages, and that's better, but it's still not the best. The best way is to use the chart itself and let the chart tell you where to get out if the trade goes against you and where to take your profits if it goes in your favor. Now, when you're looking at the chart itself, there are basically, there are a number of these, but there are basically three places to put your stop loss. You can key your stop loss off of a moving average. You can key your stop loss off of a support trend line, or you can key your stop loss off of a support line. Now, the difference between a support trend line and a support line is something that we talked about in Chart Reading 101, so I won't go over that here in the detail, but let's look at the first of these, the moving average stop loss. So the moving average stop loss works something like this. This is the S&P 500. Let's zoom in a little bit here and get a better picture. It's a nice new uptrend. We know it's a new uptrend because we see the crossover of the 20-period moving average to the 50-period moving average right here in early April. After setting this deep pivot low, look at that nice little hammer candle there. Almost a hammer candle, but it's quite close to one, and that really marks the nice low there, pivot low. And we have this nice thrust up, a little pullback, thrust up, pullback, thrust up, pullback. And let's say you want to buy this pullback right here, back down to the upsloping 20-period moving average. We're still pretty new in this uptrend, and you figure there's still some upside left. So you want to buy on this nice green candle. This is, by the way, the long reversal formation right here, although it's not much of a downtrend, so we wouldn't necessarily be looking for one here. But let's say you bought it here. To use the moving average, you have a couple of choices. I always have the 20-period moving average, the 50-period moving average on all of my charts, and you can use the 20-period moving average as your key for a stop loss if you're more aggressive. And by more aggressive, I mean you're going to use a tighter stop loss, and your anticipation is that the stock will be moving very quickly, very shortly, and you anticipate this being a short-term trade, maybe a couple of weeks, 3 weeks at the most, and then you're out. So you use the 20-period moving average when you anticipate a short-term trade, strong price movement right away. You want to capture it as much as you can without staying in the trade too long. Use the 50-period moving average if you see this as more of maybe a position trade, a trade that you anticipate holding for quite some time, maybe 2 to 3 months rather than 2 to 3 weeks. So let's say we use the 20-period moving average, and very simply you would just put your stop loss somewhere underneath the average, maybe right about in that area. And if you were using the 50-period moving average, then you would do the same. You would put it underneath the 50-period moving average. And of course, as the moving average trends up, you would trail your stop loss up. The same is true with the 50-period moving average. You continue to trail your stop loss up. Where would you then exit this trade? You would exit on any tag below the 20-period moving average. You don't want to put it, like right underneath it. You want to give it a little bit of space. So you would probably trail it up like so, and somewhere in that area there, you would probably be stopped out. And you would end up with a nice little trade. Now, if you're trading the S&P or the Spider, you're not going to make a whole lot of money from that, but maybe you're trading options on the Spider, maybe you're trading the E-mini, the S&P futures index, or maybe you're just keying off the S&P 500 to trade one of the components of the index itself, and you would still use the same technique to set your stop loss. If you're using the 50-period moving average, you're going to be trailing this up as well as the trade matures, and you can see you're in the trade quite a bit longer, and you would probably get stopped out right about in that area. You're not going to be making much more than you would have made with the 20-period moving average, and that just worked out that way in this case. And you would have held the trade for several more weeks for only a few cents more in profit. Okay, so that's how we use the moving averages to set our stop losses. The other technique that we can use for setting our stop loss is a trend line drawn underneath the support lows or the pivot lows. And remember, we're entering the trade right here, so there aren't too many pivot lows prior to that. Here is a pivot low. Here's a pivot low. This one down here is so low that we wouldn't be able to draw much of a trend line using that low. So we would probably key off this one, and if we draw our trend line underneath those two, we end up with something that looks like that. And that would we would put our stop loss underneath that trend line, and anytime that trend line gets violated, then we would be out of the trade. I don't know what happened here on the 1st or 2nd of June. That looks like some bad data to me. I don't think it was a flash crash. That looks like just one of those strange anomalies. I don't think that's the product of high-frequency trading. I think that's just a bad print on the chart. So we probably wouldn't be stopped out on that little tag of the trend line, although it's interesting that it did come down to the trend line. Rather, we would be stopped out here on this candle like so, which also violates the 50-period moving average. So that you would be in the trade all the way up until here, and so you would have gotten a little more profit from the trade as opposed to getting out here underneath the moving average, but not a whole lot more, and you're holding on to the trade for another 3 or 4 weeks. So you have to decide whether you want to stick with moving average or trend line, whatever gives you the best risk to reward ratio. Now, you don't know your reward side of the equation until you set your target price, but we'll see how that works in just a minute. So then the third way of setting your stop loss is to use a straight support line. Remember, a trend support line is at an angle. It is a diagonal line drawn under pivot lows in an uptrend, and a support line is always a horizontal line drawn that it keys off the low pivot lows. So you would put in a horizontal line. You're in the trade right here, so that immediate pivot to the left is likely to be the pivot low that we will key on. You would put your stop loss somewhere underneath that horizontal support line, and then as the trade moves up in your favor, you would move the support line up to the next pivot low, and your stop loss is moved up accordingly. And then as the trade moves in your favor and pulls back again and then thrusts back up, you would move your support pivot up again, and your stop loss is moved up again. And it looks like you're still in the trade to this point. Again, we'll ignore that bad print. And then we get another pivot low right here. So we're still in the trade. We move it up to about here, and our stop loss is underneath that. And of course, we would then be stopped out right here about this red candle, which is again pretty close to where we would have been stopped out with all the other techniques. So those are the three ways: the moving average, support trend line, and a straightforward horizontal support line. 3 ways you can monitor your trade. You always want to move up your stop loss to the moving average support trend line or horizontal support line, so that you're always reducing your risk. That's one of the essentials of trading, is always reduce your risk as much as you can. Okay, so where do we then set our profit target? Here we are in the trade, here mid-April, April 21st, and we have it behind us a nice uptrend, and the best way to set your profit target is to draw a trend line over the tops of the pivot highs. And that would give you, if we draw it right there, that would give you your price target. So if we're in here on the 21st of April, and we've got our stop loss either down below the moving average or down below the trend line or down below the horizontal support line, we see that price is moving up, up, up. I don't think it would have hit on this day, but it certainly did. It would have opened right at our profit target, and we would exit the trade here quite a bit higher than our stop loss. This is one of the reasons why you always want to set a profit target. You set a profit target, put an actual hard order to sell your shares at the profit target. Now, if you're entering the trade right here, then your profit target is keyed to this level. But as the trade matures, your profit target changes. See how it keeps going up, keeps going up? So you're going to keep raising your profit target. You're going to have to monitor this each day, but that's part of trading. It's a daily task. You keep monitoring it, and then you're stopped out right around the open of this day about 3 weeks later. And you've got a pretty healthy little return there on that trade. Okay, so those are the ways that you will set your stop losses and target exits. Let's look ahead at a different kind of trading dynamic. How about this one right here? This is a little different now. We have a rollover into a downtrend. And let's say that you've done some good chart analysis and you've determined that this area right in here is an area of very strong distribution. You feel that prices, the index has topped out at about that place, around 122, and it's not going to go any higher, and you have a few open longs. You want to hedge with a nice short position in SPY. And then where do you put your stop loss, and where do you put your target price? Something like this. Stop loss is fairly straightforward. You can't really use the moving average because you're entering the trade in this area here. You're above the moving average, and you don't want to put the stop loss at the place where you entered. So moving average is more or less taken out of the picture initially. It will come back into the picture as the trade matures. What you would want to do is key off the horizontal resistance line. You would simply put your stop loss somewhere above that horizontal resistance line, knowing that any break above that violates your assumption that that is the price high. And then as the trade matures, you would simply move your horizontal resistance line down, and your stop loss comes down as well, like so. And then as a trade matures, you would keep putting your horizontal line at every new pivot high and move your stop loss down accordingly. Once you have the trade demonstrating this kind of action where pullbacks, or in this case relief rallies, up into a moving average, once you have that kind of thing going on, pushing back down away from it, then you can use the moving average as your stop loss. So at that point, you could key off of the 50-period moving average, and then once you see that price holds pretty strongly below the 20-period moving average, you could get a little more aggressive and start to move your stop loss down to just above the 20-period moving average. In that case, then, you would have been stopped out probably somewhere about here. So you have to be a little dynamic. You have to be a little flexible when using the chart to determine your stop loss. And as the chart itself changes, you have to flex with it. But you've got these three tools for setting stop losses. You've got the moving average, you've got the trend line, and you have the horizontal support and resistance lines. Let's look at what we didn't look at the trend line just yet to see how that would function. But once you have this pivot high and this pivot high going on, then you can draw your trend line, and again you'd be stopped out right about in there. Same place you'd be stopped out with the moving average stop loss. Note that if you were giving this a little more room and a little more time to mature and had used the 50-period moving average as your stop loss key, you would still be in the trade and you would be able to take advantage potentially of this further downside action as you move your stop loss down, and you might have been stopped out right about in there, but of course you give yourself a little bit of room. You certainly would have been stopped out in that area right there. So you would be in the trade for another month or so, but you would have profited really not much more, not much more than the 20-period moving average or the trend line support. So all three techniques are valid techniques, and you'll see that it really just depends on your own sense of the market going forward, but it also depends on the chart itself. So let's look at where you would then set your profit target in a trade like this. Now normally, when you have an established trend, you would, in a short sale like this, where you're expecting downside movement, you would use the pivot lows to put in your support trend line, extend that out to the right edge, and the support trend line would then become your target. But because we're entering up here before the new trend actually begins, we don't have a trend yet to key our support trend line off of. There are a couple of different things that you can do in a case like this. I mean, obviously the closest target would be the 50-period moving average. So if you wanted to hold on just for a couple of days, you could have taken profits right in this area right here, a very short-term trade. You would have nailed a couple of dollars on the downside. Nothing wrong with that. But in a swing trade that you're expecting to hold for, say, 2 to 3 weeks, you would want something a little further away than that, give yourself a little more room. And of course, you also want to maximize your risk to reward profile of the trade. In this case, what I would do is I would add a third moving average. So let's do that. We'll add on the 200-period moving average, and that gives us a downside target here, which was violated on those 2 days there. You would have taken your profits in this area, which actually coincides quite nearly to where you would have been stopped out had you used the 50-period moving average, and roughly where you would have been stopped out had you used the 20-period moving average, maybe a little lower than that case. But you're also in the trade for 5 fewer weeks. And that's what I mean by maximizing your risk to reward profile versus the time in the trade. You want to maximize your reward to time ratio. You want to take the most amount of profit in the least amount of time. And a moving average target like this functions much better than waiting for the trade to mature and then drawing in your trend line. If you had drawn in a trend line, once the trend actually did appear, you would have to, it's a very messy chart, but you'd have to do something like that, which wouldn't have been hit in this period of trade. You would have been stopped out before then. Let's look at one more chart here, and let's assume that you've come across this. Sorry, let's get come on now. Let's get right here. Let's assume that you've come across this nice hammer candle, which is pretty close to a long, short, long formation. And certainly if you're just looking at the bodies of those 3 candlesticks, you've got a nice long, short, long reversal formation at the end of a significant downtrend, and it's right at the 200-period moving average. And this is the S&P 500 we're talking about here. And you know, when the S&P 500 gets oversold, 9 times out of 10, you get a nice bounce. Same is true on the upside. So here we have this nice three candle formation. And let's say we want to buy this. So we buy this hammer candle, or maybe we buy the close of the reversal candle on the right side there. And we're saying, where should I put my stop loss? I can't use the 20 period moving average, that's above me. The 50 period moving average, that's above me. If I put in a support trend line, I've got something like that. That's feasible, but that's at such a sharp angle, and it's going to keep on going down. I really don't. That's too much risk, and I don't want my stop loss to be getting further and further away from my entry. So in this case, my only choice is the horizontal support line. So that's my horizontal support line. It's underneath the pivot low of the day of entry, or the day prior to entry, and so my stop loss would go just a little bit below that. And as the trade matures, here we have a nice bounce. We're moving back up to the upside. We tag the 50 period moving average, which may well have been our target in this case. But if you wanted to set a higher target, you also could have put in a trend line over those two pivot highs. And once price tags that, you're out. Once price hits your stop loss, you're out. And of course, your stop loss, you are moving up as the trade matures. You might have a little pivot low there, so you'd move your stop loss up underneath. And you're still in the trade, still in the trade, still in the trade. And you can see you would have been either there or there. But still in the trade because your stop loss is making nice progress here. Remember, you're keeping it underneath the line, not at the line, but underneath the line. And so you're out of the trade up in this area. Down here to up there. Nice little trade. All right, on to the next section. Section number 7, using intraday charts to pinpoint entries into new positions. So in this section, we're going to talk about how to enter a new trade using the chart itself. We just looked at how to use the chart to set your exit prices, both your stop price if the trade goes against you, your target price if the trade goes in your favor. Now we're going to look at the third component of trading, and that is the entry itself. The entry is a far less important facet of your trading compared to your exits. It is still important, and there are some pretty cool ways to make sure you get in at a pretty decent place and even shave some cents off your entry, which reduces your risk and adds to your profit potential. What I did was I ran the trend trading toolkit, a couple of the longs scans there, a pullback scan and a breakout scan, and pulled out a few candidates that might be interesting to look at. And I'm not saying that these are decent trades going forward. We'd have to do far more due diligence on each of these. We'd have to look at fundamentals. We'd have to look at weekly charts, that sort of thing. But just from a face value, these look like pretty decent long setups. Here we have CALD, Calidus Software. It's in a strong uptrend. As you can see, both 20 and 50 period moving averages are rising. The 20 period moving average is well above the 50 period moving average, and price is pulling down into the 20, pushing away, pulling into the 20, pushing away, and here it is pulling into the 20 again with a nice reversal candle. And just on the face value, this looks like a nice little ABC pullback, as we talked about before, and I would expect price to, from here, move higher. I'm not worried about reward to risk ratio, not worried about anything else. I just want to look at the chart to determine where is the best place to enter. To do that, I like to look at intraday charts. We're now on the daily chart. Let's scroll down first of all to the hourly chart and see what that looks like here. And the two things to note about using intraday charts to pinpoint your entries is that you want to enter at one of two places. You want to enter either at a place of support, or you want to enter at a place above resistance. So if the price is currently trading at resistance, I will pass on it and I will set my I will look either at another trade, or I will wait until the price becomes more favorable. Now, In this case, we're looking here at a nice clear A, B, C pullback. We can see support is here in this area around $10 per share. Price has pushed off support and has pulled up on the hourly chart into the 20-period moving average. Now, the 20-period moving average proved to be resistance in the previous rally into resistance. And without doing any further work to see what sort of volume we have going on in this little rally, I'm tempted to say at this point that I would wait to see whether this little pullback, this little rally into the 20-period moving average is indeed the end of the downtrend, or whether we're going to get another rollover. So I'm a little concerned right now that it is trading at resistance instead of above resistance. Yes, it is slightly above the 20-period moving average, but it still hasn't cleared it sufficiently enough for me to feel good about the entry. Moreover, if I draw in a trend line using the two previous pivot highs, I get something that looks like that, and that also places me right up against some resistance. So just on the hourly chart, I would be hesitant to enter at this point. One further thing to note is that the previous pivot low, still you're trading underneath resistance and quite close to resistance. We're not really at a place of support, and we're not at a place above resistance. So what I would do is I would wait to see whether price can clear these two lines, the downsloping trend line and the horizontal resistance line. If price can close above that, I'm in, which would be about 1032, 1033. If not, I'm going to wait. Now, the other thing is that I would like to enter at a place of support. So if price pulls back down into this area, let's say right about in there, which captures 1, 2, 3, 4, 5 touches of recent price, that's around $9.90 per share. If price pulls back down into that area, that's another area I would like to buy this stock at. So either a close above or a close at, a close above resistance or a close at support, and I'm good to go. So that's looking at the hourly chart. Now, if I were to scroll down to the 10-minute chart, I'm going to see something like this. This is that uptrend. Here's that place of support, and we can see that it is quite strong support. We don't have the trend line drawn in just yet, but we do know from the hourly chart that it is coming into a place of resistance. However, this does look like it's got some pretty good momentum going with it. It's pulling back down into the 20-period moving average and pushing back up, into the 20-period moving average and pushing back up. If it pulls back down into the 20-period moving average again, I might want to buy it there. That would be about 1020. So that's another way of pinpointing your entry. If I really, really want to buy this stock, then I'm either going to wait till it trades up to about 1032, down to 990, or if I'm very desperate to get in, let's say I really need to buy it today because tomorrow I can't look at the markets, I'll put in a limit order somewhere in this area, maybe about 1019, and wait for the pullback into that pivot low. Let's look at another chart. Let's go back to our daily chart and see what we can see. Let's put in RSOL. This is a solar stock, and solar stocks have been pretty crazy lately. And this is an interesting chart because it did have a lot of fun stuff going on back here in May. And then you have this nice, long, rounded bottom. A rounded bottom after a sharp up thrust is usually quite bullish. Here we have the strong breakout, and following that breakout, we have a ABC pullback into the rising 20-period moving average. This is a new uptrend. Here we have the crossover. So anything after that crossover is considered to be, at least in potential, an uptrend, especially once the 50-period moving average starts turning up. We have a nice pullback, and I quite like this as a potential entry point for this stock going forward on the long side. But let's say if we can't pinpoint our entry a little more carefully. We scroll down to the hourly chart, and we see this, and here we can see a nice area of price support at around just under 330 per share. And so we're very near to that. We're at 337 right now, and this is real-time trading during the day. So I might be tempted to put in a bid, limit bid at around 330, and just let it sit the rest of the day to see if I can't get that low. That would be a nice entry in my case, in my opinion. We also have what looks like a double bottom forming here. Here's the left bottom, the pivot center, the right bottom, and I'm expecting price to continue back up from there. We also have some other things going on, so we can draw in your downsloping resistance trend line over the top of those pivot highs. If price were trading up in this area, I would not buy it until it crossed and closed over that resistance trend line. If we scroll down to the 10-minute chart, hourly and the 10-minute charts are the two that I use to pinpoint these kinds of entries. We scroll back out a little bit, and there's that double bottom, and we can see we're just sort of tinkering around in this area, and 330, 329 is our area of support. So I'm likely to put in my order right around 330, maybe even 331, and I'll just leave it there for the rest of the day and see if we can't get an entry at that point. And if I can get an entry there, I've saved myself a nickel on a $3 stock, and again, that sort of stuff is going to add up over time. And that's the sort of thing that you want to do. Now, if price doesn't come down to 331, but instead carries up higher, then I want to make sure that it closes above some resistance. We have this pivot between these two lows right here around 345, and we also have this downsloping trend line right about there. And I want to make sure that price clears both of those levels. We also have the downsloping 50-period moving average, which it's going to run up into here eventually. And all of this area in here is going to cause some congestion. Likely it's going to cause price to kind of trail sideways for a while to consolidate. I would like, ideally, as a lower risk entry, to see it close above 345. So I'm either going to buy it at 331 or above 345. Those are your two possible entries using the intraday chart. Let's look at one more chart. This is a breakout chart of AEO, which is American Eagle Outfitters. It is a clothing store, and it's been pretty hard hit lately, but it has cleared a new 40-day high. That's a breakout in my book. I call that a blue sky breakout. And you can see that it has cleared some area of resistance there, and it also is now trading into a gap zone. The upper part of the gap is right there, so it has a little bit of overhead space to run before it hits the upper edge of that gap. And there's also a large gap unfilled above that, way up here, and that may well, in fact, be a kind of a nice target for this trade. But here we are down here. We have cleared some resistance, and we're starting to consolidate above that level, which is bullish. We've got a lot of nice green candle stuff going on here, and you'd have to check volume to confirm this is a solid breakout, but it looks like it's a pretty nice one. But to pinpoint my entry, I'm going to scroll down first to the hourly chart, see what's going on there. And we can see that we are, in fact, this looks really nicely bullish. We've got some bad data there. That does happen. I don't know why those bad prints happen, but we've got a nice rounded bottom on the hourly chart. A lot of good bullish stuff going on here. It's a new uptrend, pulling back into the 20-period moving average, consolidating underneath that resistance pivot there, clearing it, pulling back into it, now trading sideways. I actually like this as an entry right about here, but I can pinpoint that a little bit more carefully. I can shave maybe a nickel or so off my cost basis by going down to the 10-minute chart and seeing what we can see. This is a nice looking triangle formation. If we put in the resistance line there and the support line down here, this is consolidative, it's very bullish, and we can see it has pulled back already into the rising 50-period moving average, and it's getting pretty close to this support trend line. I could buy it right here at 1552. If you wanted to shave a couple more cents off, you could put in a limit bid at about 1548, and that would get you into this little pocket right there where I'm guessing it's going to get a nice bounce and then break up through the resistance line. If not, consolidating a little bit further and then breaking up maybe the next trading day. So that's how we use intraday charts to pinpoint our entries into positions. But again, just to repeat, your entry is far less important than your exit. So if you need to enter at the open of the market, or if you need to put on a market on close order to enter because you're not able to do this kind of intraday work, don't worry about it. You can still be a very profitable trader. I, however, like to buy things on bargain, and I like to save a few cents here and there, so I use the intraday chart to do just what I did. Okay, on to our next and last section. Section number 8, putting it all together, the 5-step chart reading method. Right, so here we are at the end of our time together, almost 3 full hours. Wow, a lot of information I've thrown at you. Apologies if it's overwhelming. I would recommend going back through it, review any bits and pieces that you had some trouble with or found difficult or were falling asleep through. Feel free to email me if you have any questions. But let's get down to this last section here. We're not going to look at any more charts. We've done all that work already. I'm simply going to give you the process that I use when I find new trades each trading day, both for the fund that I manage and for our 3 newsletters. The first thing you want to do before you do any selecting of stocks is to set up a watch list. And you want to have a healthy set of stocks or charts that you have bookmarked or put into a watch list, and you can do that in FinViz, you can do that in StockCharts.com, in Metastock, or any other charting package that you use. You should always be able to build watch lists of charts in unlimited amounts. I usually set up a list of between 50 to 70 charts, and I gather those charts from a variety of sources. I run technical scans. I usually run them almost every day. The Trend Trading Toolkit in Metastock is a great source, a resource for that. I have scans that you saw I built into StockCharts.com, and I also have scans that I built into FinViz. I run those just about every day. I have a number of fundamental scans that I use as well to find stocks that are very sound fundamentally or weak fundamentally for shorting. So I run fundamental scans, and I also like to keep a list of my favorite stocks that I'm very interested in for whatever reason. Maybe it's a company I kind of like. Maybe they've got a good product that I like to use. Maybe it's my daughter's favorite pair of jeans, the company that buys those or makes those sorts of things. And you also want to keep a list of story stocks that are in the news, stocks that are coming out with new products, biotech stocks that are working on a groundbreaking cancer drug. Put those into a list also. So you've got your watch list of stocks. It could be several lists or it could be one big list. It doesn't really matter. But you have a place to go to when you're looking for new trades, rather than feeling overwhelmed by the 8,000 stocks that are out there in the stock market. Whittle it down to a manageable level of 50 to 70 stocks, and refresh that list every few days or every couple of weeks. So that's the first thing you want to do. That's not even one of our 5 steps. That's just a preliminary step. Once you're at that point, you've got your watch list, the first thing you want to do is to take those charts, each and every one of them, and draw in trend lines if it's in a trend, and draw in support and resistance lines if the chart is in more of a range-bound condition where it's trading sideways. You'll know pretty much just by eyeballing the chart whether it's in a trend or whether it's in a range-bound condition, but one easy trick to do that is just look at the 50-period moving average, the simple moving average 50 period. If it's rising, you're in an uptrend. If it's falling, you're in a downtrend. And if it's flat, you're in a range-bound period. So draw in those trend lines, the support and resistance lines, the very things we talked about in Chart Reading 101, and that will give you a really good visual feel for where price is currently relative to either resistance or support. Second thing you want to do is draw in any chart patterns. Should be an N in that word. Draw in any chart patterns that you see. Remember, we looked at 7 chart patterns. There were 4 bullish patterns and there were 3 bearish patterns. See if you can eyeball those patterns on the chart, either in the current price formation or in the recent past, say in the last couple of months of trading. And that will give you a good sense whether price is consolidating, whether it is pushing off a bullish low, or whether it's falling from a bearish high, and just about everything in between. Third step is to look for tradable setups. So now you've got your charts fairly well marked up with trend lines, support and resistance lines, chart pattern lines. The next thing you want to do is, within that context, within those boundaries around the trading movement, the price movement, you want to find places of entry. You want to find stocks that are right now set up to enter the trade. And that can come in a variety of forms. You can use your indicators, do indicator analysis as we looked at. The CCI is maybe not quite as good here. We use that for other reasons, as we saw. But the Bollinger Bands, if it's trading down near the lower Bollinger Band or up near the top of the upper Bollinger Band, if the OBV is above or below the 21-period moving average, those sorts of things, you're looking for stocks that are nicely set up to make a predictable movement in price. You also want to do candlestick analysis at this point. You want to look for those hammer candlesticks or those long reversals, those long, long reversals. You want to look for those sorts of things on the chart. Those give you the green light to say this stock is ready to go. You can buy it today, sell it short today. If you don't have those things on the chart, then you're just in a wait and see mode with that particular chart. Just pass on it. In a group of 50 to 70 charts, you should find, a really healthy handful of charts that are ready to go, ready to buy or sell short on any given day. Step 4 is determining then your stop loss, where you're going to set your stop loss and where you're going to set your target price. You always want to, and this is, by the way, you're only doing this on the charts that have those passable entries that you determined in step 3. So now you've got just a small handful of charts, 4 or 5 charts, and on each of those you want to determine where you would put your stop if you were to buy it or sell it short, and where the likely target is going forward of price. And then from there, you are going to determine the reward to risk ratio, and you want to make sure you have at least a 1.5 ratio for that trade. Anything less than 1.5, you'll pass on it. And if you have, say, 5 stocks and only 1 or 2 are up above, say, 2.0, those are the 2 you would key on. Those are your best trades right there. And then lastly, the last step is getting into the trade. And you want to use intraday charts, as we just saw, for pinpointing your best entry. You want to, again, enter either at support or above a place of resistance on the intraday chart. You can use the hourly chart to give you a very good sense of where price is likely to be heading. And then if you really want to get very detailed, you can scroll down to the 10-minute chart for a real precise entry. So that's it. The last thing I would say is simply make your trading fun. If at any time your trading ceases to be fun, and there are certainly times when it does, it's no fun at all to sit through a drawdown, then I would suggest getting smaller in size, taking fewer trades, even taking some time off. Get back into some trading books, read up, review this webinar, take one of our webinars online. Contact me for private coaching if you're interested in that. I do a fair bit of that. And in any case, see if you can assess what's going on in your trading if you're not having fun, so that you can step back into it with a great deal of excitement, enthusiasm, and passion, because trading should be a passionate endeavor. It's a lot of fun when it works well, and our aim is to help you do that more often than not. All right, bless everybody. Thank you for watching this. Feel free to email me if you have any questions, and we'll see you on the trading floor. Bye now.